A Note About Benjamin Graham by Jason Zweig. Before the insights contained within this volume were introduced to the world, the realm of money management was akin to a shadowy medieval guild. It was an environment governed heavily by folklore, baseless superstition, and arcane rituals. With his groundbreaking analytical work, the architect of these pages irrevocably elevated this chaotic pursuit into a disciplined modern profession. He was not merely a phenomenally successful participant in the markets, he was the preeminent practical philosopher of finance. His masterpiece for the individual, the volume you are about to explore, stands as the inaugural work to lay bare both the psychological scaffolding and the rigorous analytical instruments required for enduring financial triumph. It remains the definitive treatise on the subject, unmatched in its clarity and utility. Decades after its initial publication, the text possesses an uncanny, almost prophetic resonance. Those who encountered it during the dizzying heights of late 20th century market frenzies, or right before the brutal corrections that inevitably followed, were struck by its unyielding premise. Every period of euphoric, unchecked market optimism carries the seeds of a devastating reversal. The wisdom contained herein is timeless, offering a sobering, stabilizing anchor against the intoxicating pull of runaway bull markets and the crushing despair of eventual crashes. This profound wisdom was not forged in an isolated ivory tower, but in the crucible of harsh personal experience. Born in London just before the turn of the 20th century, his early years after immigrating to New York were steeped in comfort and privilege. However, the untimely death of his father plunged his family into a relentless descent toward extreme hardship. The ultimate blow arrived during the financial panic of 1907, when his mother, having risked their fragile savings on borrowed money in the stock market, was entirely ruined. The bitter sting of poverty, epitomized by the sheer humiliation of a bank teller questioning the worth of a mere $5 check written by his mother, left an indelible mark on his soul, permanently shaping his aversion to financial recklessness. Yet, exceptional brilliance offered an escape from this despair. A scholarship to a prestigious university revealed a mind of breathtaking capability. Graduating near the absolute top of his class, he was extended offers to teach in the departments of philosophy, English, and mathematics, all by the astonishing age of 20. He declined academia, choosing instead to plunge into the tumultuous arenas of Wall Street. Beginning at the absolute bottom as a simple clerk, he rapidly ascended the ranks, evolving into a master analyst, becoming a firm partner, and eventually commanding his own highly successful investment enterprise. His early days were marked by the very manias and deceptions that would plague later generations of speculators. He witnessed firsthand the hollow promises of hyped public offerings, making swift fortunes in emerging industries, only to see the underlying companies exposed as complete frauds mere months later. To combat this chaos, he developed an investigative method of almost molecular precision. He would sift through the most obscure, neglected regulatory filings, unearthing hidden troves of high-grade assets concealed within otherwise unremarkable businesses. By identifying companies trading for far less than the cash and bonds they secretly held, and by demanding management unlock that value, he engineered extraordinary returns and pioneered a new standard of rigorous due diligence. Even a titan is not immune to a global economic cataclysm, and the Great Depression inflicted harrowing, staggering losses upon his portfolio. Yet, he emerged from the rubble not just intact, but fortified in his convictions. By systematically harvesting the deeply discounted bargains left in the wake of the crash, he constructed a long-term track record that stands among the greatest in financial history, consistently outpacing the broader market by a commanding margin over 2 full decades. His unparalleled success rested upon a foundation of immutable principles, doctrines that resonate just as powerfully in modern times as they did during his life. First, a stock must never be viewed as a mere electronic blip or a flickering ticker symbol. It is a tangible ownership stake in a living, breathing commercial enterprise, possessing an intrinsic value entirely divorced from its daily quotation. Second, the market itself is a ceaselessly swinging pendulum, perpetually oscillating between the extremes of unjustifiable euphoria and unwarranted despair. The pragmatic investor learns to purchase from the despondent and sell to the euphoric, refusing to be swept up in the emotion of the moment. Third, the ultimate reward of any financial commitment is mathematically bound to the price paid. The steeper the entry cost, the more anemic the eventual return will be. Furthermore, because absolute certainty is an illusion, the risk of miscalculation can never be fully eradicated. It can only be mitigated by a relentless insistence on a margin of safety, a steadfast refusal to overpay, regardless of how intoxicating the prospect may appear. Ultimately, the true theater of investment is not the stock exchange, but the human mind. Financial destiny is dictated by the ability to cultivate independent, critical thought and the patient fortitude to ignore the infectious mood swings of the crowd. The behavior of your assets is vastly overshadowed by the discipline of your own behavior. This revised edition seeks to bridge the gap between these timeless doctrines and the volatile realities of the contemporary financial landscape. While the original prose remains untouched, it is accompanied by modern commentary designed to illuminate the liberating, practical applications of these historical truths to today's markets. For those embarking on this journey for the first time, or those returning to refresh their perspective, this classic work promises to profoundly alter your understanding of the economic world, serving as a steadfast guide to a vastly more intelligent and secure financial future. Introduction. What this book expects to accomplish. The ultimate objective of this text is to equip the everyday individual with a coherent, actionable doctrine for the allocation of capital. The focus here will not linger on the intricate mathematical mechanics of analyzing individual securities. Instead, the narrative will pivot toward the fundamental philosophies and the psychological postures that are absolutely required for enduring financial success. A deep and abiding understanding of market history is paramount to this endeavor. One cannot safely navigate the turbulent waters of finance without rigorously studying how various asset classes, both fixed income and equities, have behaved through past decades of shifting economic weather. The diligent allocator must be forearmed with the knowledge of past financial storms and euphorias, for as the old philosophical warning dictates, those who fail to remember the past are unequivocally condemned to repeat its bitterest lessons. This work is addressed entirely to the true investor, drawing a stark and unforgiving line between disciplined ownership and market speculation. It must be stated immediately that this is no effortless map to untold riches nor a convenient guide to overnight fortunes. To illustrate the sheer danger of such fantasies, one need only look back to the grandiose promises made at the precipice of the great collapse of 1929. Prominent, respected voices in the financial establishment publicly claimed that a mere pittance saved monthly and placed into equities would magically blossom into a massive, life-altering fortune within 2 decades. When subjected to the cold light of reality and the actual historical returns of the market, that grand promise falls staggeringly short, proving the absolute folly of relying on overly optimistic, mathematically flawed assurances. Yet, even in the shadow of that shortfall, the disciplined practice of steady, relentless purchasing, regardless of market euphoria or despair, yields a highly respectable, compounding reward that validates the quiet power of consistency. The pure speculator trades entirely on the momentum of the crowd, governed by the fallacious belief that one should buy simply because a price has risen and sell purely because it has dropped. This herd mentality runs completely counter to all rational business logic applied anywhere else in the commercial world. Over a half-century of continuous observation confirms that chasing the market's shifting shadow is a fundamentally flawed pursuit, virtually guaranteed to culminate in lasting financial failure. The financial landscape shifts constantly, and the environment has evolved dramatically over recent years. The market has endured severe turbulence, unprecedented spikes in the yields of high-grade bonds, precipitous drops in the valuations of leading equities, the insidious and persistent creep of inflation, the reckless rise of convoluted corporate conglomerates, and the catastrophic, unthinkable collapse of once impregnable institutions. These phenomena demand careful reflection, yet the bedrock tenets of sound capital allocation remain entirely unchanged, even as their practical application must adapt to the new, harsher climate. A recent and severe market contraction has permanently shattered the dangerous illusion that dominant equities could be purchased at any price, at any time, with guaranteed impunity. The market has violently returned to its historical reality, a place where profound and agonizing declines are just as likely as exhilarating ascents. For those who blindly chased unproven secondary enterprises and newly minted public offerings, the resulting devastation was absolute. It is a harsh but necessary reminder that while unbridled enthusiasm may fuel brilliant progress in other human endeavors in the financial markets, it leads almost exclusively to catastrophic ruin. Furthermore, a profound shift has occurred in the relationship between fixed income securities and equities. There was a time when stocks offered a vastly superior yield to bonds, compensating the owner for the inherent risks of equity. That dynamic inverted dramatically, with premier bonds suddenly offering returns that heavily dwarfed the dividends of blue-chip stocks. This necessitates a rigorous re-evaluation of the traditional balanced division between the two asset classes, a subject that demands deep consideration of inflationary pressures and the preservation of purchasing power. Two distinct paths emerge for the participant. The passive or defensive allocator seeks primarily to shield themselves from devastating errors and to eliminate the burden of constant, agonizing decision-making. Conversely, the aggressive or enterprising allocator willingly sacrifices significant time, intellect, and energy in the pursuit of superior returns. While historically this extra exertion was handsomely rewarded, modern conditions cast shadows of doubt on whether such premiums can still be reliably extracted. Nevertheless, the pursuit of superior selection remains a vital, fascinating discipline for those willing to endure its rigorous intellectual demands. A pervasive, enduring myth suggests that financial triumph lies simply in identifying the fastest-growing industries and plucking out their most promising champions. Yet, hindsight reveals this to be a perilous and deceptive trap. The obvious certainty of an industry's physical expansion rarely translates into guaranteed wealth for its financial backers. Consider the commercial aviation sector, where explosive, revolutionary increases in passenger traffic were repeatedly accompanied by catastrophic financial losses and bruised shareholders. Even the most highly compensated, full-time professionals frequently fail to accurately predict the trajectory of these seemingly obvious growth stories. The vital lesson is twofold. Undeniable physical growth does not equate to undeniable financial profit. And even the foremost experts lack a foolproof method for capturing the most promising enterprises in the most promising sectors. The central aim here, therefore, is to erect impenetrable guardrails against catastrophic misjudgments and to cultivate a psychological framework within which the allocator can comfortably, rationally reside. Indeed, the greatest hazard facing any market participant is not the fluctuating tape, but their own reflection. As conservative individuals are increasingly forced into the volatile arena of equities to combat the erosion of inflation, they become dangerously exposed to the intoxicating temptations of market frenzy. Fortifying the mind against these emotional vulnerabilities is the ultimate requirement. Far more wealth has been preserved by ordinary individuals possessing the proper, steady temperament than by brilliant minds completely lacking in emotional discipline. A relentless habit of measuring and quantifying must be ingrained in the mind. Every asset has a price at which it becomes a compelling acquisition and a price at which it becomes a toxic liability. The fatal losses of recent years were entirely avoidable if participants had only paused to ask the simple grounding question of how much they were paying for the underlying value. When one treats the purchase of a business with the same meticulous, calculating price consciousness as purchasing daily groceries, the path to preservation becomes wonderfully clear. A positive, structured approach to equities is essential. By demanding that investments be acquired at prices grounded firmly in tangible asset values, one escapes the whimsical tyranny of market moods. The owner of such soundly priced enterprises can rest easy, knowing they possess a rational, defensible stake in a thriving business, entirely independent of the market's manic depressive fluctuations. This grounded, profoundly conservative posture consistently outpaces the thrilling but perilous pursuit of glamorous, anticipated growth. The great paradox of this discipline is that respectable, highly satisfactory outcomes can be attained with minimal effort and rudimentary capability, yet to elevate those results even slightly above the average requires an extraordinary, almost Herculean exertion of wisdom and application. The graveyard of finance is filled with highly intelligent people who attempted to bring just a little extra cleverness to the market and failed spectacularly. The allure of outperforming the crowd is immensely strong, but the mathematical reality proves it to be an incredibly steep climb. A simple, unwavering balance of premium bonds and a diversified basket of leading businesses remains the safest harbor. Venturing beyond this secure territory is an invitation to profound psychological and analytical challenges that must be approached with the utmost caution. Looking back over decades of unimaginable global conflict, economic upheaval, and unprecedented national prosperity, one unwavering truth emerges. Through every unforeseen calamity, closed exchange, and triumphant boom, the rigorous application of sound, unyielding investment principles has consistently protected and expanded wealth. We must proceed into the unknown future with the absolute comforting conviction that these principles will continue to do so. The text makes absolutely no pretense of offering a magic formula to effortlessly conquer the financial markets. Any volume that makes such a sweeping claim is inherently deceitful. Instead, the ultimate goal here is to instill three enduring pillars of financial wisdom: the absolute necessity of minimizing catastrophic unrecoverable losses, the framework for cultivating steady, sustainable growth, and perhaps most crucially, the psychological armor required to defeat the self-sabotaging instincts that constantly derail human potential. When speculative manias take hold, the very concept of losing the vast majority of one's capital seems like a laughable impossibility. Yet, history ruthlessly proves that entire sectors can be annihilated, leaving participants with a mere fraction of their wealth. The mathematical brutality of such a loss is severe. A near total wipeout requires a monumental, nearly impossible subsequent gain merely to return to the starting line. Taking a foolish risk can dig a trench so deep that climbing out becomes a lifelong, futile struggle. Thus, the avoidance of profound loss is not a secondary consideration. It is the absolute epicenter of the philosophy woven throughout these pages. This naturally brings us to a fundamental question: what exactly constitutes the intelligence of an intelligent investor? This specific brand of intellect is entirely divorced from standardized test scores, advanced degrees, or sheer computational brainpower. It is fundamentally a manifestation of character. It demands an extraordinary reservoir of patience, an unyielding discipline, an insatiable desire to learn, and the emotional fortitude to subjugate irrational fears and greedy impulses. The financial landscape is littered with the wreckage of brilliant minds who lacked this specific temperament. Consider the catastrophic collapse of highly leveraged hedge funds engineered by Nobel laureates and mathematical savants whose staggering intellects could not save them from the hubris of assuming the market would perfectly conform to their theoretical models. Or look back to the origins of modern science, where one of the greatest physicists in human history, a mind capable of calculating the celestial mechanics of the universe, found himself swept up in the collective madness of a historic stock bubble. Despite initially realizing the absurdity of the soaring prices, he ultimately succumbed to the roar of the crowd, re-entered the frenzy at its absolute peak, and surrendered a massive fortune. His genius could map the stars, but it was powerless against the gravitational pull of human greed. Financial failure is rarely a symptom of stupidity. It is almost exclusively the result of an undisciplined character surrendering to the hysteria of the herd. A stark review of recent financial history provides a harrowing chronicle of calamity, vividly illustrating the cost of such emotional surrender. The dawn of the new millennium ushered in a breathtaking destruction of equity values, erasing trillions of dollars in accumulated wealth. The architects of the preceding boom, the seemingly invincible titans of technology and telecommunications, saw their valuations pulverized, while countless digital startups evaporated entirely into the ether. This era was simultaneously plagued by breathtaking corporate malfeasance. Respected, sprawling conglomerates were exposed as hollow facades built on fraudulent accounting, leading to unprecedented bankruptcies. Executives siphoned off unimaginable sums while auditors and analysts, who were entrusted to protect the public, turned a blind eye or actively participated in the deception. Against a backdrop of plummeting interest rates and escalating global anxieties, the environment became a minefield. Yet, the tragedy is that the vast majority of this devastation was entirely avoidable for anyone anchored to the doctrines of intrinsic value and emotional restraint. Those who abandoned these principles for the intoxicating thrill of the moment became the architects of their own demise. The era's most dangerous illusion was the absolute conviction that specific technologically advanced sectors represented an infallible path to unending prosperity. Prominent voices in the financial establishment publicly ridiculed the archaic notions of valuation, declaring that traditional metrics were obsolete in the face of a revolutionary new paradigm. They proudly asserted that the digital revolution was a perpetual wealth creation machine, and those who hesitated were hopelessly tethered to a bygone era. They completely disregarded the eternal truth that the obvious rapid expansion of a physical industry absolutely does not guarantee magnificent returns for its financial backers. By the time an economic trend becomes universally recognized as a certainty, the price of admission has already been bid up to such stratospheric heights that future returns are destined to be abysmal. The blind pursuit of the next inevitable economic miracle is a perennial trap, continually ensnaring those who refuse to acknowledge that no asset is worth an infinite price. Yet within the wreckage of dashed hopes and collapsed valuations, a profound silver lining inevitably emerges. The great pendulum of the market, having swung to the terrifying extreme of irrational exuberance, invariably reverses course, plummeting toward the opposite pole of unjustifiable despair. As the masses rush to liquidate their holdings in terror, the very assets that were dangerously overpriced during the boom become deeply, irrationally discounted. It is a supreme irony that the collective crowd eagerly accumulates equities when prices are soaring and risk is at its absolute zenith, only to violently discard them when prices have plummeted and the true risk of ownership has been drastically diminished. For the disciplined, emotionally grounded allocator of capital, a bear market is not a harbinger of doom, but a magnificent clearinghouse of opportunity. Provided one has secured the necessary cash reserves to weather the storm and meet immediate needs, the plunging market should be welcomed with open arms. It is the mechanism by which solid businesses are returned to the bargain bin. The death of a raging bull market is the fertile soil from which the intelligent, patient preserver of wealth harvests their greatest, most enduring triumphs. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. The foundational distinction between the prudent allocation of capital and the blind wager of wealth must be established before any meaningful journey into the financial markets can begin. The definition crafted decades ago remains absolute and resolute. A true investment is a carefully structured operation that, through rigorous, exhaustive analysis, guarantees the preservation of the original principle while offering a reasonable, adequate return. Any financial commitment that fails to satisfy these stringent, unyielding criteria is, by definition, a speculation. Over the course of modern financial history, the public's understanding of this dichotomy has undergone a radical and highly dangerous transformation. In the harrowing aftermath of the catastrophic market collapse of the late 1920s, the prevailing wisdom dictated that all equities were inherently speculative. Solely high-grade bonds were deemed worthy of the noble title of investment. Today, however, the pendulum has swung violently to the opposite absurd extreme. The term has been democratized to encompass anyone who participates in the market, regardless of their methods, their impulsiveness, or their total ignorance of underlying business value. This corruption of language is not a minor semantic quibble. It is a profound and systemic mischief. When a novice purchases a handful of shares based on a fleeting emotion, a breathless rumor, or the sheer momentum of a rising price, labeling them an investor falsely equates them with a disciplined, calculating preserver of capital. The institutions that govern the financial exchanges would do well to sharply remind the public of the inherent, inescapable risks woven into the very fabric of equity ownership. To obscure the line between a calculated acquisition of a business interest and a blind bet on a fluctuating quotation is to invite widespread, catastrophic ruin. While a speculative component is virtually unavoidable in the purchase of most modern equities, the intelligent participant's task is to strictly confine and monitor that element. Outright speculation is not a moral failing, and it can indeed provide a thrilling diversion, but it becomes financially fatal the moment it is confused with genuine investment. For those who simply cannot resist the allure of the wager, it is imperative to quarantine those speculative funds entirely, ensuring they never contaminate the primary conservative portfolio or infect the rational mind. Turning to the defensive participant, the individual who seeks the preservation of wealth coupled with an absolute minimum of mental exertion and emotional distress, we must examine the anticipated returns of a truly conservative posture. Looking back over the guidance provided in previous eras, the central, unwavering doctrine advocated for a balanced, mechanical division between high-grade fixed-income securities and premier blue-chip equities. The golden rule dictated that neither component should ever represent less than a quarter or more than 3/4 of the total portfolio, with a perfectly even division serving as the most logical stabilizing baseline. In earlier decades, the anticipated returns were calculated in a tranquil environment where high-grade bonds offered modest yields and stock dividends were similarly constrained. The projections suggested a steady, unspectacular compounding of wealth, firmly rejecting the euphoric, dangerous guarantees of perpetual, double-digit market ascents that had so thoroughly captivated the public imagination. However, the financial climate underwent a seismic, unprecedented shift in the subsequent years. The most staggering development was the relentless surge in the interest rates commanded by premium bonds reaching heights never before witnessed. Simultaneously, the dividend yields of major industrial equities languished or declined as prices soared. This created a jarring, painful paradox for the conservative allocator. While long-term bonds suddenly offered historically massive yields, their principal values were utterly decimated by the rising interest rate environment, inflicting severe capital losses on those who held them for safety. Ironically, during a period marked by persistent inflation, a macroeconomic condition theoretically favorable to the ownership of equities, the safest harbor proved to be the most liquid short-term cash equivalents, which preserved principal while capturing the rising yields. This brutal, unexpected reality reinforces the eternal truth that the future trajectory of asset prices, whether stocks or bonds, remains entirely beyond the realm of human prediction. Assessing the landscape in the early 1970s, the defensive allocator is confronted with premium corporate bonds yielding magnificent returns, while the dividends of leading industrial equities appear anemic by comparison. A purely mathematical calculation might tempt one to abandon stocks entirely in favor of the assured, robust income of bonds. Yet the insidious, silent threat of inflation looms over any fixed income strategy, threatening to steadily devour the purchasing power of those guaranteed returns. Because the future remains permanently clouded by the dual threats of rampant inflation and unpredictable market collapses, the balanced, compromise approach remains the only impenetrable armor. By maintaining a significant, unyielding commitment to both asset classes, the defensive allocator surrenders the fantasy of maximum possible gains in exchange for the absolute certainty of survival. They must shun the siren song of newly floated, highly promoted stock offerings, relying instead on the established, monotonous reliability of diversified, industry-leading enterprises or the mechanized, emotionless discipline of steady, incremental purchasing over time. For the enterprising participant, the active pursuit of superior returns requires traversing a far more treacherous and intellectually demanding path. The first and most critical hurdle is to ensure that their vigorous efforts do not result in a performance inferior to the passive, effortless index. It is remarkably easy to bring vast energy, sharp intellect, and intense dedication to the financial markets, only to channel those virtues into self-destructive handicaps. The active allocator must systematically and ruthlessly eliminate the deeply flawed strategies that captivate the broader public and the institutional herds. Attempting to trade on the market's rhythmic swings, anticipating short-term earnings surprises, or attempting to identify the fastest-growing companies of the distant future are all endeavors fundamentally doomed by the sheer weight of competition and the impossibility of flawless foresight. To achieve a genuinely superior outcome, the enterprising allocator must embrace philosophies that are inherently logical, yet profoundly unpopular on Wall Street. They must relentlessly exploit the market's manic tendency to chronically overvalue the glamorous and ruthlessly undervalue the neglected. Historically, great reliable fortunes were secured by purchasing obscure, unloved businesses trading at fractions of their liquid working capital, or by engaging in the meticulous, highly specialized arithmetic of corporate reorganizations and liquidations. While the frequency of these glaring, easy anomalies has diminished as the market's mechanisms have evolved and competition has sharpened, the underlying principle remains entirely untouched. The active pursuit of wealth is not a game of predicting the future better than the crowd, but rather the arduous, disciplined practice of calculating the value of the present more accurately than the hysterical masses. The ringing of the closing bell on the stock exchange is greeted with raucous cheers by floor brokers every single day, regardless of whether the market soared to new heights or plummeted into the abyss. Their jubilation is rooted in a simple, ruthless truth. They generate wealth from the sheer volume of transactions, utterly insulated from the financial triumphs or tragedies of the participants. Engaging in the frantic swapping of equities, rather than anchoring oneself to a long-term ownership stake, dramatically diminishes the probability of building personal wealth while enriching the intermediaries. A genuine investment operation demands 3 unyielding pillars: exhaustive scrutiny of the underlying business, a deliberate shielding against devastating loss, and the pursuit of a satisfactory rather than extraordinary return. The true allocator calculates the worth of a commercial enterprise and purchases a fraction of it at a rational price. The gambler wagers that an electronic quotation will rise simply because a greater fool will emerge to pay an even higher premium. For the speculator, the ceaseless flickering of the ticker tape is the oxygen that sustains them. For the disciplined owner, daily quotations are a mere distraction, and true peace of mind comes from a willingness to hold a stake, even if the stock market were shuttered for years. While the casinos of Wall Street are heavily rigged to ensure the house ultimately devours the speculator's capital, the realm of intelligent ownership is a unique arena where the odds heavily favor the participant who adheres strictly to the doctrines of value. Operating at breakneck velocity, the modern financial arena has dangerously blurred the boundaries between calculated ownership and reckless wagering. During eras of immense market euphoria, an entire nation can transform into a collective of frenetic traders, leaping from one fleeting trend to the next with the chaotic energy of swarming insects. The prevailing delusion dictates that any tactic producing a temporary windfall is inherently brilliant, completely ignoring the reality that sustainable financial victory requires methods that are structurally and consistently sound. Flashy, high-speed maneuvers, such as rapid intraday trading or frantically rotating mutual funds, may yield intoxicating short-term profits during a roaring bull market, but they are mathematically and logically doomed to fail over a lifetime. Just as driving at suicidal speeds might temporarily shorten a journey, the catastrophic risk of a fatal collision renders the strategy entirely foolish. The holding periods for equities have violently contracted over the decades, shrinking from patient, multi-year commitments to frantic, months-long flings. Even the most prestigious institutional money managers succumbed to this hyperactivity, dumping billions of dollars of high-technology holdings in a matter of weeks and abandoning all pretense of long-term stewardship in favor of the terrifying mantra that every single second counts. The architecture of modern finance has been dangerously gamified, propelled by relentless marketing campaigns that portray market participation as a frictionless avenue to instant riches. Advertisements routinely depict utterly uninformed individuals clicking a mouse and reaping thousands of dollars, or professional coaches making multi-million-dollar financial decisions without a shred of analysis. As millions of citizens logged onto electronic trading platforms, the financial markets were effectively reduced to a ceaseless national video game, streaming mesmerizing but utterly hollow data into every home and business. In this environment, the crucial connection between a stock and the living commercial enterprise it represents is completely severed. Equities become pure abstractions, mere blips on a screen. If the blips ascend, nothing else matters. Companies with business models explicitly designed to bleed cash and offer services for free saw their valuations rocket upward, entirely untethered from economic reality. Participants no longer bothered to learn the names, let alone the balance sheets of the businesses they were purchasing, relying instead on catchy ticker symbols to execute trades with maximum velocity. This profound financial dyslexia reached such absurd heights that traders inadvertently drove up the prices of obscure, unrelated companies simply because their abbreviations resembled those of heavily hyped digital startups. The market degenerated into a cynical echo chamber where astronomical price targets were plucked from thin air by charismatic analysts, instantly triggering massive buying frenzies based on nothing but the hollow promise of infinite future growth. Beyond the frantic pace of day trading, the landscape is littered with the wreckage of seemingly foolproof mechanical formulas that promised effortless wealth before ultimately failing. Every few years, a newly championed methodology emerges, promising quick, painless market dominance, only to violate the fundamental principles of genuine investing. One such historical illusion relied on the calendar, suggesting that hoarding obscure small capitalization equities in late December and discarding them in January would magically guarantee superior returns. While tax loss harvesting and institutional window dressing did historically create a brief anomaly, the relentless publicity surrounding this tactic flooded the market with eager participants, inevitably eroding the very price advantage the strategy relied upon, while exorbitant trading costs devoured whatever meager gains remained. Other highly promoted, patented systems promised market-crushing returns by blindly purchasing baskets of stocks based solely on rigid, backward-looking metrics like consecutive earnings increases and price-to-revenue ratios. These automated strategies, heavily marketed to the public as time-tested miracles, collapsed almost immediately after their widespread adoption, suffering brutal, multi-year losses as the broader market soared past them. Similarly, simplistic formulas advocating the blind purchase of the highest-yielding, lowest-priced components of major industrial averages were touted as risk-free paths to wealth. Yet, these methods utterly lacked the exhaustive analytical rigor required of a true investment, offering no genuine diversification and zero protection against profound fundamental deterioration. When these arbitrary formulas inevitably disintegrated, they crushed the capital of those who had been seduced by their false simplicity. All mechanical schemes are plagued by a self-destructive destiny. If they are born of random statistical illusions, time will swiftly expose their emptiness. If they are rooted in genuine historical anomalies, their very popularity will obliterate the advantage. The undeniable conclusion is that the primal urge to gamble must be recognized and strictly quarantined. The intelligent allocator isolates a small, strictly limited fraction of their total wealth, never exceeding a tenth of their resources, into a segregated, speculative account, ensuring that the intoxicating thrill of the wager never contaminates the sober, lifelong discipline of preserving and growing their true capital. Chapter 2. The Investor and Inflation. The relentless erosion of purchasing power has gripped the consciousness of the financial community, transforming the fear of a shrinking dollar into a dominant psychological force. The undeniable reality that a fixed income and a static principal will buy fewer goods and services as the cost of living escalates has led many to a sweeping, yet dangerously flawed conclusion. The prevailing sentiment often dictates that fixed income securities are inherently flawed instruments, and consequently that equity ownership is the only logical refuge. This extreme perspective has even infiltrated the management of charitable endowments, pushing them toward portfolios composed entirely of equities. This represents a drastic departure from an earlier, equally absolute era when only the highest-grade bonds were deemed worthy of the title of investment. The rational allocator of capital must reject both of these absurd extremes. It is an intellectual fallacy to declare that any equity, regardless of how inflated its price or how meager its dividend, is universally superior to a well-secured bond. To navigate the treacherous currents of inflation, one must seek guidance not in contemporary hysteria, but in the sober, unyielding records of financial history. The phenomenon of a depreciating currency is by no means a modern invention. An examination of economic cycles stretching back to the early 20th century reveals massive, sporadic surges in the cost of living, interspersed with periods of sharp deflation and stretches of creeping, persistent price increases. The historical record confirms that the investor must absolutely anticipate and prepare for the continued gradual erosion of the dollar's purchasing power. Operating on the assumption of a steady, moderate annual rate of inflation is the only prudent course. The immediate mathematical consequence of this creeping inflation is that it silently devours a significant portion of the yield generated by high-grade bonds. However, this distressing reality must not be exaggerated into a reason for panic. A disciplined investor who consumes only a portion of their fixed income yield and reinvests the remainder can successfully maintain the true, inflation-adjusted value of their principal. The vital question then arises: does the inherent nature of common stocks provide a guaranteed, built-in mechanism to effortlessly outpace this inflationary decay? The historical data reveals that over the span of many decades, the combined return of dividends and capital appreciation from leading equities has indeed surpassed the yield of fixed income instruments, but the future is never a flawless mirror of the long-term past. The critical distinction lies between the sprawling canvas of a lifetime and the immediate, agonizing year-to-year realities that actually dictate human behavior and psychological endurance. When we transition into the relationship between inflation and corporate earnings, a sobering truth shatters the myth of equities as an infallible shield. There is absolutely no direct, dependable correlation between a rising general price level and the upward trajectory of corporate profits or stock prices. In fact, during periods of significant inflation, the fundamental earning power of American corporate capital, the actual rate of return generated on the tangible assets of a business, has frequently demonstrated a marked decline. The massive expansion of corporate earnings over recent decades was not the magical byproduct of inflation, but rather the result of immense, continuous reinvestment of retained profits back into the businesses. If inflation acted as a genuine catalyst for prosperity, it would have measurably increased the profitability of existing capital. Instead, the historical ledger proves that inflation has been a heavy burden on the corporate sector. The mechanics of this burden are profoundly evident. Wage demands consistently outstrip gains in actual worker productivity, squeezing profit margins relentlessly. More alarmingly, the voracious need for capital to merely sustain existing operations forces corporations to borrow staggering sums of money. The explosive, multifold expansion of corporate debt over a 20-year period, coupled with soaring interest rates, has transformed borrowing from a tool of expansion into a menacing headwind. If modern corporations had not heavily leveraged their balance sheets with this massive influx of debt, their actual return on equity would have plummeted even further under the weight of inflationary pressures. A notable exception exists within the public utility sector. Often perceived as the primary victims of inflation due to rigid regulatory oversight, these enterprises actually possess a unique strategic advantage. Because their unit costs for delivering power and communication have historically risen far slower than the general cost of living, and because they are legally entitled to charge rates that ensure an adequate return on their invested capital. Utility monopolies are structurally positioned to defend their shareholders against the ravages of a depreciating currency. Faced with the uncertainties of corporate profitability, many seek refuge by exploring alternatives to common stocks as inflation hedges. The traditional, primitive instinct of those who distrust fiat currency is to hoard precious metals. Yet, over a vast expanse of time, the open market price of gold has frequently failed to match the simple, compounding interest of a standard savings deposit, while burdening the owner with the absolute absence of yield and the constant drain of storage costs. The outright failure of this ancient haven casts a dark shadow over the modern impulse to seek financial salvation in tangible objects. The markets for rare art, first edition literature, diamonds, and numismatic collections are plagued by artificial pricing, extreme illiquidity, and an undeniable element of the precarious. The rational allocator of capital will recognize that navigating these esoteric markets requires a level of specialized expertise that borders on the impossible for the layperson. Similarly, the direct ownership of real estate is often championed as the ultimate fortress against inflation. While genuine fortunes have been built in property, the landscape is violently cyclical, heavily reliant on geographic luck, and fiercely punitive to those who miscalculate acquisition prices. Furthermore, it denies the average individual the crucial stabilizing benefit of broad diversification, rendering it a highly hazardous arena for the uninitiated. The ultimate conclusion forces the intelligent investor back to the unyielding wisdom of a balanced compromise policy. The sheer unpredictability of the economic future dictates that one can never afford to place their entire financial destiny into a single vessel. To completely abandon bonds despite their contractual guarantees, or to wholly shun equities despite their historical resilience, is to succumb to dangerous extremes. The heavier the reliance an individual places upon their portfolio for daily sustenance and peace of mind, the more fiercely they must guard against the sudden, devastating shocks of the unknown. The conservative allocator recognizes that the risk inherent in purchasing a premium bond at a generous yield is fundamentally lower than the risk of acquiring an index of industrial equities at historically elevated valuations. However, the phantom menace of inflation demands the purchase of insurance. A carefully curated component of common stocks serves precisely this function. While it cannot provide an absolute ironclad guarantee against the loss of purchasing power, equity ownership carries a far greater probability of inflationary protection than a portfolio composed entirely of fixed income claims. Therefore, the defensive investor is compelled to embrace the lesser of two evils. To be without an appreciable allocation of common stocks is to invite the silent destruction of inflation. To be entirely devoid of bonds is to invite the sudden, terrifying destruction of a market panic. The middle path, though lacking the thrill of absolute conviction, remains the only mathematically and psychologically sound harbor against the storms of the future. It is remarkably easy to dismiss the corrosive power of rising prices, particularly when recent memory suggests a tranquil economic environment where the cost of living barely registers a pulse. The psychological phenomenon known as the money illusion perfectly captures this vulnerability. Human nature dictates that a nominal increase in wages, even if entirely devoured by a higher rate of inflation, feels vastly superior to a nominal decrease in a static price environment, despite the mathematical reality leaving the individual in an identical or worse economic position. The raw, absolute number printed on a bank statement or a paycheck provides a visceral thrill, completely masking the silent theft occurring in the background. Measuring financial triumph solely by the absolute gains without ruthlessly deducting the invisible toll of inflation is a profound self-deception. Furthermore, dismissing the threat of inflation is historically illiterate. The harrowing economic stagnation of the 1970s, characterized by double-digit inflation that crippled the financial system and decimated the purchasing power of the currency, stands as a stark warning. Looking beyond domestic borders, the vast majority of market-oriented nations have suffered through periods where annualized inflation eradicated more than half of an investor's wealth. Finally, sovereign governments burdened by massive debt possess an inherent, inescapable motivation to cheapen their currency, allowing them to discharge their obligations with depreciated funds. The conventional wisdom broadly prescribes the accumulation of equities as the ultimate shield against this monetary decay. Yet this prescription is dangerously incomplete. A rigorous examination of market history reveals a far more complex relationship between stock prices and the cost of living. During periods of mild price increases, corporations can successfully transfer escalating costs to the consumer, allowing equities to flourish. However, when inflation accelerates violently, it acts as a suffocating weight on the broader economy, forcing consumers to drastically curtail consumption and paralyzing corporate profitability. In such extreme environments, the stock market routinely falters, delivering abysmal returns that fail to protect the owner's purchasing power. While equities have successfully outpaced inflation in the majority of historical measurement periods, they have failed to do so in roughly 1 out of every 5 instances. A shield that shatters 20% of the time cannot be blindly relied upon as an absolute defense. Fortunately, the modern financial landscape offers specialized instruments explicitly designed to fortify a portfolio against the ravages of inflation, allowing the intelligent allocator to expand their defenses beyond traditional equities. The first of these involves pooled investments in commercial and residential properties, structured to collect and distribute rental income. These real estate entities, when bundled into accessible portfolios, provide a formidable buffer as property values and rents traditionally rise in tandem with the broader cost of living. While not an infallible armor, they offer a vital layer of defense without significantly dragging down long-term performance. The second, and perhaps most flawless mechanism, involves government-issued securities explicitly tethered to inflation metrics. Backed by the absolute credit of the national treasury, these bonds eliminate the risk of default, while simultaneously guaranteeing that the principal value will automatically adjust upward as the cost of living escalates. They represent an elegant fusion of absolute capital preservation and guaranteed purchasing power. There is, however, a critical nuance. The tax authority treats the upward adjustment in principle as immediately taxable income, despite the fact that it is a phantom, unrealized gain. Because of this administrative paradox, these inflation-protected securities are optimally sheltered within tax-deferred retirement accounts. By allocating a meaningful portion of one's fixed income assets to these specialized instruments, the defensive investor secures a fortress of absolute safety, placing a portion of their wealth permanently beyond the invisible, grasping reach of inflation. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. An individual's collection of equities represents merely a microscopic fragment of a vast, formidable, and perpetually shifting institution. To approach this arena with prudence, one must possess a deeply ingrained understanding of its historical contours. It is essential to grasp the magnitude of the market's overarching pendulum swings and to trace the perpetually changing relationships between the prevailing prices of equities and their underlying earnings and dividends. Armed with this historical panorama, a participant is properly equipped to cast a rational, critical eye upon the allure or the peril of the market level at any given moment. By an elegant coincidence, a robust statistical record of these financial metrics stretches back precisely 1 century, offering a sweeping view of how the share economy has navigated countless cycles of prosperity and panic. Observing the broad sweep of the market's trajectory over the 7 decades leading up to the 1970s, 3 profoundly distinct epochs emerge. The first, spanning the dawn of the 20th century to the mid-1920s, was characterized by a series of fairly regular, moderate market cycles lasting a handful of years each, resulting in a steady but thoroughly unspectacular annualized advance. This era of predictability was violently shattered by the second phase, the euphoric, unbridled boom that culminated in the catastrophic collapse of 1929. The aftermath of this disaster was a grueling 2-decade span of erratic, agonizing fluctuations. By the close of the 1940s, the annualized rate of growth measured from the mid-20s had dwindled to a microscopic fraction, leaving the broader public utterly disillusioned and deeply hostile toward the very concept of equity ownership. By the infallible law of market opposites, this pervasive gloom set the stage for the third historical epoch, the most colossal and relentless upward surge in financial history. Over the next 2 decades, the leading industrial averages multiplied their value more than 6-fold, compounding at an astonishing double-digit annual pace that entirely ignored the modest contribution of dividends. This unprecedented ascent bred a dangerous, intoxicating complacency. A widespread illusion took root, suggesting that these magnificent returns were a permanent guaranteed feature of the modern financial landscape, rather than a historical anomaly. Few paused to consider that the sheer velocity and magnitude of the rise might be the very proof that it had been perilously overdone. This prolonged euphoria was finally punctured by a severe, terrifying contraction at the close of the 1960s. A plunge that ruthlessly eradicated the paper wealth of the most speculative, highly promoted enterprises and reminded the surviving participants that markets are fully capable of moving in 2 directions. To fully comprehend this century of financial history, one must look beyond the mere fluctuations of price and examine the vital underlying currents of corporate profitability and dividend distributions. When viewed across decade-long averages, the record reveals a persistent though highly variable bedrock of fundamental economic growth. Yet within this broad narrative of progress, alarming deteriorations occasionally materialize. At the dawn of the 1970s, the profitability of corporate capital abruptly plummeted to depths unseen since the shadows of global war. This severe erosion of earning power, accompanied by a shocking resurgence of major corporate bankruptcies, served as a stark indicator that the golden era of effortless economic expansion had abruptly concluded. Equally fascinating, and perhaps even more critical to the student of finance, is the radical psychological transformation of the investing public, which is most clearly measured by the shifting multiples they are willing to pay for corporate earnings. In the desolate market trough of the late 1940s, equities were discarded at valuations of a mere 6 times their trailing profits, while offering immense dividend yields that utterly dwarfed the meager returns available on premium bonds. Fast forward slightly more than a decade, and this relationship had inverted with breathtaking extremity. The public, now thoroughly intoxicated by the promise of perpetual growth, eagerly paid more than 20 times earnings for the exact same market indices. Simultaneously, the dividend yield on equities collapsed to a fraction of its former self, while the interest rates demanded by high-grade bonds surged to unprecedented heights. This complete psychological reversal, from demanding massive compensation for the perceived risk of stocks to accepting negligible yields in exchange for the promise of limitless appreciation, stands as the most remarkable shift in attitude in the entirety of recorded financial history. Gazing upon the market landscape in the early months of 1972, with the major industrial averages hovering near the 900 mark, one is compelled to evaluate the safety and sanity of these valuations. It is a highly instructive exercise to revisit past appraisals of the market's altitude. In the deeply discounted environment of the late 1940s, objective metrics clearly declared that equities were fundamentally undervalued. A few years later, as prices climbed, the landscape appeared favorable but demanded a watchful, cautious posture. By the close of the 1950s and absolutely by the mid-1960s, the momentum of the market had carried it to heights that could only be described as objectively perilous. Those warnings of danger, though initially mocked by the continued speculative ascent of the indices, were ultimately and violently vindicated when the market eventually collapsed under the weight of its own overvaluation, completely devastating the trendy speculative darlings of the era. Applying this same rigorous historical lens to the prevailing prices of early 1972, the arithmetic paints a distinctly uninviting picture for the conservative allocator. While the raw multiple of price to recent earnings does not appear at its absolute historical zenith, this metric cannot be viewed in a vacuum. When the valuation is juxtaposed against the towering yields currently available on risk-free, high-grade bonds, the relative attractiveness of equities evaporates. The disparity between the meager dividend output of stocks and the robust interest payments of fixed-income securities has grown to an extreme, historically unfavorable extreme. From the perspective of pure demonstrable value, the equity market at these levels offers virtually no margin of safety. Furthermore, the psychological atmosphere remains deeply troubling. The financial community exhibits a startling, almost pathological amnesia, readily dismissing the harrowing, wealth-destroying experiences of just a few years prior as a minor, irrelevant interruption. This heedless disregard for recent trauma is a classic symptom of an unhealthy market environment. Such institutionalized ignorance rarely goes unpunished. The objective observer must conclude that the terrain is fraught with hazard, pointing toward the likelihood of either a sudden, severe replication of the recent market plunge, or perhaps a final, blinding, speculative blow-off that will inevitably culminate in an even more catastrophic reckoning. Faced with this precarious, inflated environment, the prudent course of action is dictated by the timeless principles of capital preservation. The mandates of caution articulated during previous periods of unjustifiable exuberance must be strictly enforced. Under no circumstances should borrowed capital be utilized to finance the acquisition or retention of equity positions. The proportion of a portfolio exposed to the hazards of the stock market must not be expanded. Instead, a rigorous, defensive posture requires that if the equity allocation exceeds a balanced, even division with fixed income assets, it must be methodically reduced. The painful but necessary extraction of capital gains taxes must be endured, and the liberated funds must be securely locked away in the sanctuary of premium bonds or cash equivalents. While those adhering to a mechanized, continuous purchasing program may elect to maintain their discipline, initiating new, heavy commitments into such a dangerously elevated market demands an emotional stamina and an appetite for severe temporary loss that the truly conservative participant simply does not possess. In observing the wild prognostications that often accompany roaring financial eras, one sees a staggering detachment from historical reality. During periods of immense prosperity, a chorus of voices inevitably rises to declare that the extraordinary gains of the recent past are practically guaranteed to stretch endlessly into the future. Such a period materialized vividly at the close of the 20th century, accompanied by a flood of literature promising stratospheric milestones for the major industrial averages. The foundation of this boundless optimism rested on the assertion that equities had consistently delivered robust, inflation-adjusted returns for nearly 2 centuries, leading to the incredibly dangerous assumption that stocks were inherently less risky than conservative fixed-income instruments. This profound misconception bred a culture where the actual price paid for a business was deemed irrelevant, so long as the asset was held for a sufficient duration. The era was saturated with financial authorities publicly defending the most absurd valuations, arguing that traditional metrics were obsolete in a revolutionary new world order. High-technology enterprises, completely devoid of actual earnings, were championed as perpetual wealth machines, and dismissing them based on exorbitant prices was labeled a fool's error. Yet the eternal laws of financial gravity ultimately asserted themselves, delivering a devastating rebuke to those who believed the old rules had been repealed. The favored enterprises of these very pundits suffered catastrophic wealth-eradicating plunges, obliterating trillions of dollars in market capitalization and proving that irrational exuberance cannot be sustained by rhetoric alone. A critical flaw embedded within the sweeping historical claims of perpetual equity dominance is the profound distortion of early market data. The assertion that stocks have universally outpaced bonds over long horizons relies heavily on historical indices constructed long after the fact. These retrospective measurements suffer from a severe distortion as they inherently capture only the triumphant survivors of early capitalism while quietly erasing the thousands of failed canals, turnpikes, and early ventures that completely wiped out their backers. This invisible graveyard of corporate bankruptcies artificially inflates the perceived historical returns of equities. When this distortion is properly accounted for, the supposed historical supremacy of stocks over conservative bonds is significantly diminished, exposing the fallacy of guaranteeing superior equity returns based on deeply flawed, heavily filtered historical records. The ultimate antidote to this intoxicating, perpetually bullish delusion is the rigorous application of basic logic. The intelligent allocator must constantly question the assumption that the future will seamlessly mirror a rosy past. If the collective market becomes absolutely convinced that equities are a riskless avenue to wealth, the resulting surge in demand will inevitably drive prices to levels that guarantee dismal future performance. The core principle remains immutable. The value of any financial asset is inextricably linked to the price paid for it, because the fundamental capacity of any commercial enterprise to generate profit is finite. The price a rational individual should be willing to pay for a share of those profits must also be finite. Even the most spectacularly talented individual in a given field possesses a calculable maximum economic value. Paying exponentially beyond that value, regardless of the individual's brilliance, transforms a sound investment into a reckless, guaranteed loss. When market participants fixate solely on the exhilarating returns of a recent boom, they inevitably cultivate a dangerous, utterly illogical expectation that such miraculous results are the new normal. During the height of the recent technological bubble, public surveys revealed an investing populace anticipating astonishing mid-teen percentage gains year after year. Even highly sophisticated institutional fiduciaries, such as those managing corporate pension plans, succumbed to this euphoria, significantly inflating their assumed rates of return to justify lowering their cash contributions. The subsequent agonizing market collapse brutally exposed the folly of these assumptions. The fundamental law of market opposites dictates that as public enthusiasm reaches a crescendo and valuations soar, the actual underlying risk of the market is simultaneously reaching its absolute zenith. Conversely, it is during the depths of market despair, when expectations are bleakest, that true risk-adjusted opportunity is born. To rationally approach the future, one must deconstruct the engine of stock market returns into its three fundamental components: the genuine expansion of corporate profitability, the broad increase in the general price level, and the shifting, unpredictable tides of public speculation. Historically, the true, inflation-adjusted growth of corporate earnings has been remarkably modest. When this authentic growth is combined with prevailing dividend yields and realistic estimates of inflation, the rational expectation for future equity returns settles at a thoroughly respectable, yet entirely unspectacular, single-digit figure. Evaluating the broader market against the smoothed, long-term average of corporate profits provides a sobering, stabilizing perspective. When the market demands an exorbitant multiple of these historically smoothed earnings, subsequent returns are frequently dismal. Conversely, when the market discards equities at a low multiple of their long-term earning power, handsome future rewards often follow. While the immediate future is forever clouded in uncertainty, adjusting one's expectations to these grounded historical realities provides a vital psychological shield. The most absolute certainty in the financial markets is that the future will inevitably surprise those who are most arrogantly confident in their predictions. By embracing a humble, conservative outlook, the intelligent participant refuses to risk their capital on the fragile, dangerous illusion of perfect foresight, finding comfort instead in the enduring truth that the most pessimistic environments consistently harbor the most magnificent future triumphs. Chapter 4. General Portfolio Policy, the Defensive Investor. The fundamental architecture of a portfolio is traditionally dictated by the specific financial circumstances and risk tolerance of its owner. A deeply ingrained yet entirely fallacious financial doctrine suggests that the rate of return an individual should anticipate is directly proportional to the amount of risk they are willing to stomach. The reality of intelligent capital allocation operates on a vastly different premise. The rewards sought should not be tethered to the appetite for danger, but rather to the amount of rigorous, intelligent effort the individual is willing and able to dedicate to the pursuit. The passive, defensive participant who demands absolute safety and a total liberation from the burdens of continuous decision-making must accept a modest minimum return. The maximum financial reward is rightfully reserved for the alert, enterprising allocator who relentlessly exercises superior intellect and exhaustive skill. The cornerstone dilemma for the defensive mind is the division of capital between the absolute safety of high-grade debt and the variable growth of premium equities. A foundational, unbreakable rule dictates that the defensive portfolio must never commit less than a quarter, nor more than 3/4, of its total funds to common stocks, with the fixed income component serving as the exact inverse counterweight. The most rational, stabilizing baseline is a perfectly equal half-and-half division between the two asset classes. While theoretical perfection might suggest increasing the equity stake during the depths of a terrifying bear market and drastically reducing it when euphoric bull markets push valuations to dizzying heights, human nature renders such a strategy almost impossible for the average individual to execute. The psychological gravitational pull of the crowd inevitably forces the public to do the exact opposite, buying frantically at the absolute peaks and selling in despair at the deepest troughs. A strict mechanical adherence to this equal division offers profound psychological and mathematical advantages. As the volatile movements of the market inevitably distort the balance, pushing the equity allocation up to, say, 55%, the allocator is forced to restore the equilibrium by selling the inflated asset and reinvesting the proceeds into the stabilizing safety of bonds. This profoundly simple mechanized discipline actively restrains the individual from being drawn ever deeper into equities as prices reach perilous, dangerous extremes. Furthermore, during a severe market contraction, the conservative participant will derive immense psychological solace from the stabilizing presence of their fixed income foundation, insulating them from the total devastation suffered by their more reckless peers. When constructing the debt component of the portfolio, the primary decisions revolve around the taxation of yield and the duration of the maturity. The choice between taxable corporate issues and tax-exempt municipal obligations is a pure, emotionless mathematical calculation dictated entirely by the individual's specific income tax bracket. For those in elevated tax tiers, the net retention of wealth is demonstrably higher with tax-free instruments. Among the universe of fixed income choices, the obligations directly issued by the National Treasury stand unique in their absolute assurance of principal and interest. Certain series of these savings bonds possess the extraordinary advantage of allowing the owner to demand full repayment at any time, shielding them completely from the severe principal shrinkage that inflicts standard bonds when prevailing interest rates rise. They combine the ultimate safety of sovereign backing with unparalleled flexibility and profound tax deferral benefits, making them an indispensable tool for the preservation of capital. Beyond these specialized savings instruments, a vast array of standard national obligations exists, offering absolute safety and freedom from state-level taxation. The market also provides the debt of states and municipalities, which offer the powerful compounding shield of federal tax exemption. However, the defensive allocator must strictly confine their purchases to those municipal issues carrying the highest possible safety ratings from established agencies, refusing to compromise on underlying quality. Premium corporate bonds provide the highest nominal yields among first-tier debt, though they remain fully exposed to all levels of taxation and must be weighed carefully against their tax-free counterparts. The temptation to reach for higher yields by sacrificing the underlying quality of the bond must be fiercely and permanently resisted. The historical ledger proves time and again that reaching for an extra fraction of a percent in annual income inevitably exposes the owner to severe price declines and the terrifying specter of outright default. The slight enhancement in yield is entirely inadequate compensation for assuming the risk of catastrophic principal loss. This treacherous territory of distressed or second-grade debt must be abandoned entirely to the highly specialized professional. In environments where standard savings deposits offer interest rates competitive with short-term premium bonds, they serve as a perfectly acceptable, highly liquid substitute for a portion of the fixed income allocation. While convertible securities and the broader implications of market fluctuations on bond prices require deeper specialized examination, the defensive allocator must remain relentlessly focused on absolute safety over any speculative features. A critical, often overlooked hazard within the bond market is the inclusion of call provisions. These clauses grant the issuing corporation the right to forcefully retire the debt prematurely, usually at a negligible premium. This creates a deeply inequitable, one-sided dynamic for the investor. If prevailing interest rates rise, driving the value of the bond down, the owner is forced to bear the full brunt of the decline. But if interest rates fall, making the high-yielding bond immensely valuable, the corporation will ruthlessly exercise its call provision, stripping the investor of their lucrative asset just as it becomes most advantageous to hold. The intelligent defense against this arrangement is to insist upon bonds with robust multi-year protection against early redemption, or to acquire low-yielding bonds at a steep discount to their face value, inherently shielding them from the threat of a call. The traditional non-convertible preferred stock represents a fundamentally flawed investment architecture. The owner of such an instrument is entirely dependent upon the corporation's ability and willingness to distribute dividends to the common shareholders. If the common dividend is suspended, the preferred dividend is instantly imperiled. Yet, the preferred owner lacks the ironclad legal protections of a true creditor and is simultaneously denied any participation in the spectacular profit growth enjoyed by the common equity partner. This inherently weak legal and economic position dictates that such instruments should be acquired solely by corporate entities who enjoy specialized tax exemptions on the dividends, or by enterprising individuals only when they are discarded by the market at massive, undeniable discounts. The structural forms of securities often mask their true utility. While the rigid obligations of standard bonds and the weak claims of preferred stocks dominate the landscape, alternative structures like income bonds, where interest is mandated only if the corporation actually earns enough to pay it, possess profound theoretical and practical advantages for both the issuer and the buyer. Yet because these instruments were historically associated with the messy aftermath of railroad bankruptcies, the financial establishment irrationally rejects them. The market stubbornly clings to its historical prejudices, happily embracing structurally flawed instruments, while completely ignoring superior logical alternatives. The degree of aggression one brings to a portfolio should be dictated not by the types of assets held, but by the investor's willingness to dedicate time and intellectual energy to the endeavor. The active or enterprising approach demands relentless research and continuous monitoring, imposing a heavy physical and intellectual tax. Conversely, the passive or defensive strategy requires minimal effort but demands a profound, almost ascetic emotional detachment from the intoxicating clamor of the financial markets. Both paths are equally intelligent and can yield tremendous success, provided the individual possesses the self-knowledge to choose the appropriate route and the discipline to suppress excessive costs and irrational emotions. This crucial distinction serves as a stark reminder that the true source of financial peril lies not merely within the fluctuating economy or the specific instruments owned, but deep within the investor's own psychology. When establishing the defensive portfolio, the foundational decision involves the precise allocation between equities and the safety of fixed income assets and cash. It is profoundly striking that this asset allocation decision should be entirely divorced from the conventional, deeply flawed wisdom that dictates risk tolerance based primarily on chronological age. The traditional mathematical formulas, which blindly subtract one's age from 100 to determine the appropriate equity allocation, are utterly nonsensical. A financially secure octogenarian, fortified by an ample pension and leaving a legacy to young grandchildren, would be foolish to hoard bonds, as the ultimate beneficiaries of the capital have decades of investing ahead of them. Conversely, a young professional in their 20s, actively saving for a home or an impending marriage, would be courting absolute disaster by placing all their capital into the volatile equity markets, leaving themselves completely exposed without a secure cushion of cash. The unpredictable shocks of life, sudden unemployment, medical emergencies, or familial crises can strike with devastating force at any age, demanding that every participant maintain a fortress of riskless, accessible cash. Furthermore, the psychological reality of market participation relentlessly contradicts the bold assertions made during periods of prosperity. When equities are soaring, it is effortless to imagine an unwavering, lifelong commitment to the market. Yet, when the inevitable brutal contraction arrives and accumulated wealth is violently slashed, the agonizing pain of loss frequently overwhelms rational thought. The urge to capitulate, to abandon equities entirely and flee to the perceived safety of cash becomes almost irresistible. The defensive investor must acknowledge this inherent human frailty. Maintaining an absolute minimum allocation of 25% in fixed income instruments is not merely a financial hedge, it is psychological armor, providing the emotional fortitude necessary to cling to equity positions when the market landscape appears most desolate. To navigate these emotional currents, the allocator must conduct a rigorous, honest assessment of their life circumstances, employment stability, and absolute financial needs, adjusting their target allocations only when those fundamental realities shift. Once this tailored balance is established, it must be maintained through a disciplined, mechanized process of rebalancing. By restoring the portfolio to its original proportions on a strict, infrequent schedule, the investor replaces frantic guesswork with cold, objective action, automatically trimming the assets that have grown dangerously inflated and acquiring those that have become temporarily depressed. The seductive notion of committing the entirety of one's wealth to the stock market must be viewed with the utmost skepticism. A portfolio composed 100% of equities is suitable only for a microscopic fraction of the investing populace. To even consider such a radical posture, one must possess a massive, untouched reserve of cash capable of sustaining their livelihood for at least a year, a confirmed investment horizon stretching across multiple decades, and the battle-tested psychological scars of having survived a catastrophic bear market without yielding to panic. Unless an individual can honestly attest to buying more equities while the broader public was fleeing in terror, they have no business exposing their entire net worth to the violent whims of the market. For the vast majority, an all-equity portfolio is a guaranteed recipe for emotional capitulation and financial ruin. Within the realm of fixed income investing, the choices have proliferated, demanding careful navigation. The decision between taxable and tax-exempt municipal bonds is a strict function of the individual's tax bracket, with taxable instruments optimally sheltered within tax-deferred retirement accounts where their income is shielded from the immediate grasp of the revenue service. The duration of the bond introduces the peril of interest rate fluctuations. Long-term bonds suffer severe principal erosion when rates rise, while short-term instruments offer meager yields. The intelligent compromise is found in intermediate-term maturities, effectively neutralizing the dangerous game of predicting macroeconomic interest rate movements. Furthermore, the sheer capital required to achieve adequate diversification in individual corporate bonds renders them impractical for all but the wealthiest individuals. For the defensive allocator, a low-cost, broadly diversified bond mutual fund represents a vastly superior, infinitely more convenient vehicle for capturing fixed income yields. When seeking to maximize the utility of cash reserves, the investor must look beyond the meager returns of standard bank deposits. The debt obligations of the National Treasury offer an unparalleled haven of safety, entirely devoid of credit risk, as the sovereign entity possesses the ultimate power of taxation and currency creation to honor its debts. These instruments, particularly those of shorter duration, remain largely immune to the destructive forces of rising interest rates and offer the added benefit of state tax exemption. Certain specialized savings bonds, entirely insulated from market fluctuations and offering unique tax deferrals, serve as the perfect repository for capital designated for future, specific obligations. Venturing beyond the absolute safety of sovereign debt requires a heightened level of vigilance. Securities backed by pools of residential mortgages offer amplified yields, but carry complex risks associated with fluctuating interest rates and the unpredictable repayment behavior of homeowners. These are best accessed strictly through the diversified umbrella of a mutual fund, completely avoiding the treacherous waters of individual mortgage derivatives. The aggressive marketing of insurance-linked annuities must be met with profound skepticism. In the vast majority of cases, the exorbitant hidden fees and punitive surrender charges embedded within these contracts entirely obliterate any theoretical tax advantages, making them a lucrative triumph for the salesperson, but a dismal failure for the buyer. Preferred stocks, structurally subordinate to debt and denied the limitless upside of common equity, remain an inherently flawed, worst of both worlds proposition. Ultimately, the most defensive investor may find that selectively incorporating the common shares of deeply entrenched cash-generating corporations with robust, sustainable dividend yields can significantly enhance the income and total return of the portfolio, proving that a measured, rational embrace of equities is a vital component of the ultimate defense. Chapter 5. The Defensive Investor and Common Stocks. In past decades, equities were viewed with deep suspicion, widely considered to be inherently speculative instruments completely unsuitable for the preservation of serious wealth. Yet, the argument for their mandatory inclusion in a conservative portfolio rests upon two unyielding pillars of financial reality. First, common stocks provide a vital, albeit imperfect, shield against the invisible, relentless confiscation of purchasing power known as inflation, a defense that fixed income instruments utterly lack. Second, over the vast stretch of economic history, equities have delivered a superior aggregate return, fueled by dividend yields that historically surpassed bond interest, coupled with the steady compounding growth of retained earnings continuously reinvested back into the enterprise. However, this historical supremacy carries a severe and unforgiving caveat. The benefits of equity ownership are entirely vaporized if the buyer pays an exorbitant price. When the market reaches euphoric heights, driving dividend yields far below bond rates and inflating valuations to astronomical levels, the traditional advantage of common stocks is dangerously compromised. The defensive allocator must therefore hold equities not out of boundless cheerful enthusiasm, but as a necessary mathematically calculated defense against the unique perils of an all-bond portfolio, accepting them as the lesser of two distinct financial evils. Selecting the actual equities for a defensive portfolio should not be an agonizing exercise in financial clairvoyance. Instead, it must be governed by a set of rigid, objective boundaries. The portfolio must possess adequate, but not excessive diversification, typically containing a minimum of 10 and a maximum of 30 distinct corporate issues. Every selected enterprise must be large, prominent, and conservatively financed, ensuring it has the massive physical and financial gravity to withstand severe economic tempests. Furthermore, the company must boast an uninterrupted record of dividend payments stretching back for decades, proving its enduring, battle-tested capacity to generate and distribute cash through both boom and depression. Finally, a strict ceiling must be imposed on the price paid, limiting the valuation to a reasonable multiple of its average earnings over the preceding 7 years. This final, unyielding constraint deliberately excludes the vast majority of highly touted, popular market darlings from the defensive portfolio. The exclusion of these popular growth stocks frequently perplexes the novice. A growth stock is defined by its historical ability to increase per-share earnings at a rate substantially above the broad market average, a trajectory enthusiastically expected to continue indefinitely into the future. While owning such magnificent enterprises seems flawlessly logical, the broader market recognizes this brilliance and prices the shares at staggering, unforgiving premiums. Purchasing these equities introduces a massive element of speculation into the portfolio. The buyer is paying heavily in advance for future prosperity that may never materialize to the exact degree anticipated. Even the most formidable corporate titans suffer violent, devastating market corrections when their astronomical valuations collide with momentary operational hiccups. The sheer mathematical reality dictates that exponential, unbroken growth cannot be sustained forever. Thus, the defensive allocator must abandon the alluring, dangerous hunt for the ultimate growth champions, recognizing that the sheer magnitude of the price paid utterly obliterates the necessary margin of safety. Once the defensive portfolio is constructed, it should not become a theater of constant nervous activity. While professional supervision and periodic review are highly beneficial, the core holdings, having been selected for their enduring stability and exceptionally conservative valuations, should require very few alterations. The urge to constantly tinker, to swap one fundamentally sound business for another in the pursuit of marginal fleeting gains, is a destructive impulse. It is an activity that merely enriches the brokerage establishment through endless friction and transaction costs, while steadily degrading the investor's long-term compounding. A mechanical, relentlessly disciplined method for acquiring these equities provides the ultimate psychological armor against market volatility. By committing a fixed dollar amount to the market at regular intervals, whether monthly or quarterly, the allocator automatically purchases more shares when prices are depressed and fewer shares when prices are elevated. This systematic approach, applied across decades, entirely neutralizes the paralyzing fear of entering the market at the wrong moment. It transforms the terrifying volatility of the stock exchange into a mathematical advantage, guaranteeing that the average cost of the acquired shares will be inherently satisfactory, completely divorcing the act of purchasing from the emotional hysteria of the prevailing market mood. The specific formulation of the portfolio must naturally reflect the profound realities of the individual's life, yet the underlying principles of selection remain surprisingly uniform. Whether guiding the modest savings of a young worker, the substantial income of a prominent surgeon, or the vital capital of a widow, the objective is not to match the portfolio to the individual's desperation for yield, but to match the strategy to their capacity for rigorous analytical effort. A widow entirely dependent on her capital for daily survival must not stretch for speculative yields out of sheer necessity. She must ruthlessly preserve her principal through a defensive, heavily armored posture. The prosperous professional, lacking the time and specialized training to master the grueling art of security analysis, must similarly embrace the passive, defensive path, resisting the supreme arrogance of assuming that success in one demanding field automatically translates into dominance over the financial markets. The young saver, while possessing the luxury of time to recover from errors, should test the waters of active analysis with only the absolute smallest fraction of their capital, utilizing the bulk of their savings to establish a mechanized, defensive foundation. The vernacular of finance is deeply poisoned by a fundamental misunderstanding of risk. Conventional wisdom mistakenly equates a temporary decline in the quoted market price of an asset with actual permanent financial risk. A genuine risk of loss exists when a bond defaults on its obligations, when a company structurally deteriorates and permanently slashes its earning power, or when an individual fundamentally overpays for an asset, ensuring a lasting destruction of capital. However, a diversified basket of soundly priced, robust enterprises will inevitably experience cyclical fluctuations in their market quotations. To label these inevitable, temporary price declines as true risk is a profound intellectual error. The legitimate owner of a business does not consider their enterprise suddenly risky simply because a panicked neighbor offers to buy it at a steep discount during an economic storm. Real risk is the permanent impairment of capital, not the temporary fluctuation of an electronic quote. The definitions governing the selection of defensive equities must be anchored in unyielding, objective reality. A conservatively financed industrial enterprise is one where the common equity represents at least half of the total capitalization, providing a massive structural cushion against the burden of debt. The terms large and prominent require a company to be a recognized leader within its respective industry, possessing the sheer scale and resources to weather severe economic contractions without facing the existential threat of extinction. By insisting on these stringent quantitative criteria, the defensive allocator intentionally filters out the chaotic noise of secondary, unproven businesses, restricting their capital solely to the undisputed, financially impregnable champions of commerce. In the chilling aftermath of a brutal market bloodbath, the natural human instinct is to shun equities entirely. Why would any defensive allocator risk another dime in an arena that recently decimated wealth so ruthlessly? The answer lies in redefining the very nature of a defensive posture. True defense is not merely a retreat from volatility, it is a calculated conservation of one's own time and analytical energy. Furthermore, the agonizing crash itself acts as a massive cleansing mechanism, violently draining the actual financial peril from the stock market. An old proverb wisely notes that a man who burns his mouth on scalding milk will blow on his yogurt. Investors, severely traumatized by the collapse of an overheated boom, inevitably view all equities as dangerously radioactive. Yet the brutal reduction in valuations transforms those same equities from scalding hazards into deeply discounted, fundamentally safe assets. The decision to commit capital must remain entirely divorced from the emotional scars of recent losses. When prevailing bond yields shrink to anemic levels, clinging exclusively to fixed income instruments for the illusion of safety is akin to seeking shelter under a lightning rod. The mathematics of discounted equities demand their inclusion in even the most conservative portfolio. A pervasive and deeply dangerous myth frequently infects the investing public: the belief that extraordinary financial insight can be gleaned simply from everyday consumer habits. The popularized mantra to invest in what is intimately familiar has been disastrously distorted. While observing a crowded parking lot at a local retailer or noticing the immense popularity of a new beverage might provide an initial spark of curiosity, it utterly fails as a substitute for rigorous financial excavation. Enthusiastic consumers blindly poured fortunes into coffee purveyors and digital storefronts simply because they enjoyed the products, completely neglecting to interrogate the balance sheets or question the astronomical, logic-defying valuations assigned to those shares. This fatal distortion of common knowledge reached its tragic zenith within the retirement accounts of major corporations. Employees, operating under the catastrophic delusion that working for an enterprise bestowed insider financial wisdom, concentrated their life savings into the shares of their own employers. When those sprawling conglomerates imploded under the weight of accounting fraud and unsustainable debt, the illusion of familiarity evaporated, leaving total financial ruin in its wake. Psychological studies confirm that mere proximity to a subject severely inflates one's unwarranted confidence in their understanding of it. Familiarity breeds a lethal complacency, transforming a supposedly defensive allocator into an intellectually lazy speculator who assumes the grueling labor of valuation is no longer necessary. For the allocator willing to undertake the necessary labor, the modern era offers unprecedented mechanisms for assembling a portfolio of individual equities. The digital revolution has spawned specialized brokerages that facilitate the steady, automated accumulation of fractional shares for a negligible fee. This technological marvel allows even the most modest streams of savings to be continuously deployed, perfectly mirroring the disciplined mechanics of a mechanical purchasing program. Furthermore, an increasing number of corporations allow the direct acquisition of their shares, bypassing the traditional brokerage apparatus entirely. However, this profound accessibility harbors a sinister temptation. The frictionless ease of electronic trading can easily seduce the disciplined owner into becoming a hyperactive speculator. If the automated accumulation of capital morphs into the frantic daily shuffling of holdings, the defensive strategy has suffered a fatal breakdown. The true defensive posture requires an almost monastic stillness. For those who lack the burning desire or the dedicated hours to dissect corporate financials, the most elegant solution remains the complete delegation of the task. The broadly diversified index portfolio stands as the ultimate defensive fortress. It delivers absolute diversification and minimal frictional costs, entirely freeing the individual from the exhausting, perilous burden of individual security selection. Navigating the turbulent, unpredictable terrain of the financial markets requires surrendering the illusion of control over macroeconomic forces and seizing absolute control over one's own mechanics. The refusal to engage in the frantic guessing game of market timing is the defensive allocator's most potent weapon. By instituting a rigid, automated program of dollar-cost averaging into a broad index of the total market, the individual is permanently liberated from the agonizing cycle of emotional euphoria and paralyzing fear. Capital is deployed with cold, rhythmic consistency, acquiring fewer shares when the market is dangerously elevated and harvesting greater quantities when panic has driven prices to unwarranted depths. This automated discipline empowers the owner to confront the endless, frantic inquiries of the financial media with a serene, invincible ignorance. When asked which esoteric sector will dominate the coming decade, or whether international equities will outpace domestic markets, the unshakable response becomes a calm admission of not knowing and fundamentally not caring. Because the automated portfolio inherently captures the entire landscape of global commerce, the need to predict isolated victories is entirely eradicated. Embracing the profound limits of one's own foresight, while institutionalizing a system that thrives on consistency, is the ultimate triumph of the defensive mind. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. The active, enterprising allocator begins their journey upon the very same foundation as their defensive counterpart, a bedrock of premium fixed income instruments and a diversified basket of top-tier equities acquired at eminently rational prices. To venture beyond this secure territory requires a formidable justification. Because the landscape of aggressive capital allocation is vast and defies rigid categorization, the most potent and reliable guidance one can offer is decidedly negative in nature. The path to superior returns is often paved by the pitfalls one consciously avoids. The enterprising participant must categorically reject the acquisition of high-grade preferred shares, leaving them to the specialized tax advantages of corporate buyers. Furthermore, they must absolutely shun the allure of secondary, inferior bonds and preferred equities unless a glaring, undeniable bargain presents itself, typically demanding a price concession of at least 30% below par value. The temptation of exotic sovereign debt must also be sternly resisted. Above all, a profound skepticism must be directed toward the continuous parade of newly minted securities, particularly those intoxicating initial public offerings and convertible instruments that flood the market during periods of extreme optimism. The pursuit of elevated yield through the purchase of second-tier bonds is a fundamentally flawed enterprise. When premium corporate obligations offer historically robust returns, it is an act of sheer folly to accept a drastically heightened risk of default or severe principal depreciation merely to extract a marginally higher interest rate. The critical distinction between a premium bond and a substandard one lies in the historical coverage of its interest charges by the underlying corporate earnings. Reaching for a slightly elevated yield from a corporation with a precarious financial structure is a classic, enduring mistake of the retail investor. When economic skies darken, these lower-grade securities inevitably suffer terrifying sinkholes in their market quotations, and the promised interest payments are frequently suspended or permanently endangered. The illusion of the so-called businessman's investment, the willing acceptance of a substantial risk to principal in exchange for a meager 1 or 2% increase in annual yield, is a mathematical and logical absurdity. A substandard bond priced near par is almost always a disastrous proposition. The rational allocator waits patiently until the inevitable market panic drives the price down to a true bargain level where the potential for significant capital appreciation finally justifies the inherent risk. While some of these depressed issues ultimately recover their footing when favorable conditions return, the agonizing volatility and the ever-present threat of permanent capital destruction make them entirely unsuitable for acquisition at full price. It is mere common sense to abstain from buying at par what historical experience dictates will likely be available at a massive discount during the next severe market contraction. The historical ledger of foreign sovereign debt is similarly marred by a catastrophic sequence of defaults, delays, and staggering losses for the domestic investor. The sheer distance and the absolute lack of legal or practical recourse when a foreign state refuses to honor its obligations render these instruments exceptionally hazardous. Across the decades, bonds issued by foreign republics and kingdoms have routinely plummeted to mere pennies on the dollar, obliterating the capital of those who chased a fractional advantage in yield. The intelligent allocator must recognize that lending capital across borders, subject to the unpredictable whims of foreign politics and economic instability, is an exercise fraught with unmanageable peril, and thus such offerings should be entirely excluded from a prudent portfolio regardless of the initial promises. The universe of newly minted securities requires the utmost vigilance and an almost impenetrable wall of skepticism. Two profound realities govern the issuance of new financial instruments. First, these offerings are invariably accompanied by the relentless pressure of highly incentivized salesmanship, demanding an equally robust resistance from the prospective buyer. Second, these securities are strategically floated during market environments that are exceedingly favorable to the issuing corporation and its underwriters, which inherently dictates that the pricing will be distinctly unfavorable to the acquiring public. As the quality of the offering descends from high-grade debt down to the speculative depths of unknown common stocks, this disadvantage becomes increasingly severe. While the institutional buyers of premium bonds are generally equipped to defend their interests against the underwriters, the retail purchaser of lower-grade debt and unproven equities is entirely outmatched. During periods of sustained market euphoria, the sheer volume of these secondary offerings explodes, pushed upon a gullible public eager for rapid profits and utterly blind to the grim historical reality that such investments, born in the heat of a boom, are almost universally destined for a dramatic and painful collapse. The phenomenon of the initial public offering during a raging bull market is a recurring tragedy of financial history. The process begins innocently enough with established private enterprises seeking public capital at somewhat reasonable valuations. However, as the broader market ascends and the appetite for speculation intensifies, the quality of the issuing companies rapidly deteriorates while their asking prices soar to exorbitant heights. The public, intoxicated by the tales of overnight fortunes and desperate not to be left behind, eagerly embraces the shares of obscure, unproven businesses, willingly paying multiples of earnings that would be deemed scandalous for the most entrenched, dominant corporations. This frantic conversion of private ventures into publicly traded vehicles is a hallmark of the terminal stages of a market boom. The heedlessness of the public and the willingness of underwriting syndicates to sell whatever can be profitably unloaded culminate in an inevitable, indiscriminate price collapse. The very same unproven equities that were hoarded in a frenzy of greed are eventually discarded in terror, often losing the vast majority of their offering price. The intelligent participant must recognize that the atmospheric pressure surrounding these new offerings is toxic to rational thought. Even if a rare, genuinely promising enterprise is buried within the avalanche of new issues, the sheer mathematical odds dictate that participating in this frantic arena is a losing proposition. The true opportunity arises years later, when the surviving entities have been utterly abandoned by the market, ignored by the very salesmen who once championed them, and can finally be acquired at a fraction of their genuine underlying worth. What an active, enterprising allocator chooses not to do is just as critical to their ultimate financial triumph as the actions they actively pursue. We must examine the modern equivalents of the negative strictures laid out for the aggressive individual, beginning with the question of junkyard dogs. The lower-grade debt instruments that the original text fiercely advised against are known in the contemporary financial vernacular as junk bonds. In previous eras, the prohibitive costs and logistical nightmares of acquiring a sufficiently broad, protective basket of these highly risky obligations made them entirely unsuitable for the individual participant. However, the modern landscape has spawned hundreds of mutual funds exclusively dedicated to scooping up these high-yield, low-quality instruments by the truckload. This evolution fundamentally mitigates the original, valid concern regarding the impossibility of adequate diversification. Nevertheless, the vast majority of these funds extract exorbitant management fees and possess a truly dismal historical record of preserving the investor's original principal during times of economic stress. While they might serve as a marginal, highly specific tool for a retiree desperate for supplemental income, or as a contrarian, anti-cyclical hedge buried deep within a tax-deferred retirement account, they remain an entirely optional and generally unattractive proposition for the intelligent mind. The catastrophic peril of chasing yield without regard for underlying business reality is perfectly encapsulated by the recent world of hurt for WorldCom bonds. Acquiring a debt instrument solely for its outsized interest rate is a recipe for heartbreak, leaving the buyer with nothing but a hollow promise when the underlying enterprise inevitably collapses under its own weight. At the dawn of the new millennium, the telecommunications giant WorldCom unleashed the largest corporate bond offering in the history of the American markets, seducing prestigious pension funds and seasoned portfolio managers alike with the siren song of massive yields. Yet the most cursory, common-sense examination of the accompanying prospectus would have revealed a terrifying reality. The corporation was hemorrhaging cash, utterly failing to generate enough operating income to cover its existing interest obligations, and was effectively borrowing billions of new dollars simply to pay the interest on its old debt. The voracious, unquestioning appetite for yield blinded buyers to the explosive danger of a company gorging itself on borrowed capital just to survive. Within a remarkably short period, the grand facade crumbled. The corporation plunged into bankruptcy amidst staggering, unprecedented accounting frauds, and the once coveted bonds lost the vast majority of their original value. No yield can ever be high enough to compensate an allocator for assuming the risk of total, foreseeable annihilation. A similarly cautious, highly skeptical approach must be applied to the modern iteration of exotic foreign debt, which we might whimsically categorize as the vodka and burrito portfolio. While the original text fiercely condemned the direct purchase of international sovereign bonds due to their horrific history of default, the contemporary market offers mutual funds specializing in the debt of emerging developing nations. No rational individual would ever commit more than a microscopic fraction of their capital to such volatile, politically sensitive and economically fragile arenas. However, because the debt of these developing economies rarely moves in perfect lockstep synchronization with the domestic stock market, a strictly limited, highly diversified exposure might theoretically offer a rare, non-correlated cushion during periods of severe domestic financial distress. It remains a deeply spicy, entirely optional additive to a broader conservative strategy, requiring a cast-iron stomach and a willingness to endure staggering volatility. We must now confront the absolute financial suicide that is dying a trader's death. The modern phenomenon of day trading, characterized by the frantic holding of equities for mere hours or minutes, is an exquisitely designed mechanism for transferring wealth from the public directly to the brokerage establishment. The invisible but massive friction of trading costs, comprising not just the visible commissions but the very real market impact of bidding up prices when eager to buy and driving them down when desperate to sell, relentlessly grinds away at capital like coarse sandpaper. When these hidden transactional frictions are coupled with the punitive, wealth-destroying taxation of short-term capital gains, the hyperactive trader is mathematically condemned to wildly outperform the broader market simply to break even. Extensive, rigorous academic studies analyzing the actual brokerage records of tens of thousands of participants definitively prove that the most hyperactive traders massively underperform the market, while the most patient, inactive owners consistently preserve and grow their wealth. The irrefutable lesson is that the term long-term investor is a profound redundancy. There is simply no other valid, mathematically sound way to participate in the ownership of commercial enterprises. To trade frantically is to guarantee your own defeat. Finally, we must dissect the lethal delusion that immense wealth can be effortlessly generated by acquiring initial public offerings, a fallacy where the early bird inevitably gets wormed. During periods of extreme market euphoria, the initial sale of a company's shares to the public is relentlessly hyped by underwriters as a guaranteed frictionless path to riches. The public is endlessly reminded of the rare, spectacular successes that multiplied in value over subsequent decades, while the thousands of newly minted equities that entirely incinerated their backers' capital are conveniently, quietly forgotten. The harsh reality is that the initial explosive gains of these offerings are almost exclusively captured by an elite private club of institutional insiders who secure shares at the underwriting price. The ordinary public is invited to participate only after the valuation has been bid up to astronomical, wholly irrational levels by the sheer force of manufactured hype. The tragic, entirely predictable saga of an enterprise like VA Linux perfectly illustrates this madness. Driven by the intoxicating, meaningless buzzwords of the era, the company's shares soared nearly 700% on their first day of public trading, valuing a fledgling business with minimal revenues and massive, escalating operating losses at billions of dollars. Rational individuals who would never dream of paying such a staggering, unjustifiable premium for a deeply unprofitable local storefront eagerly threw their capital at this electronic abstraction, completely ignoring the horrific underlying economics. They surrendered to the mass delusion that the upward trajectory of a stock price is infinitely more important than the actual tangible value of the business it represents. As the inevitable, unforgiving laws of financial gravity took hold, the enterprise bled cash, the euphoria evaporated into panic, and the shares plummeted to a fraction of a penny, wiping out those who bought at the peak. The intelligent allocator must recognize that the initial public offering is almost universally an overpriced, insider-driven opportunity that flagrantly violates the demand for a margin of safety and must therefore be entirely, unconditionally avoided. Would you like me to proceed to Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side? Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side. The enterprising allocator, driven by the definition of their very nature, seeks a financial outcome that genuinely surpasses the mundane averages. Having established the same impregnable foundation of premium fixed income instruments and reasonably priced leading equities as the defensive participant, this active mind is prepared to branch out into more demanding territories. To achieve this ambitious goal, the activities characteristically deployed in the realm of common stocks can be distilled into 4 primary avenues. Attempting to anticipate and trade upon the broad pendulum swings of the market, identifying and acquiring rapidly expanding growth enterprises, meticulously hunting for deeply discounted bargain issues, and engaging in the highly specialized arithmetic of corporate special situations. The allure of timing the broader market, buying at the absolute nadir of a depression and selling at the euphoric peak of a boom, is an undeniably intoxicating concept. Historically, the rhythmic, cyclical nature of the financial markets lent a deceptive credibility to this approach. Yet, the brutal reality of modern financial history demonstrates that attempting to forecast these macroeconomic tidal waves is an exercise in profound futility for the individual. The market's behavior has completely detached itself from the predictable historical patterns that once governed it, rendering old forecasting formulas dangerously obsolete. Therefore, the active participant is far better served by abandoning the mystical art of market prediction entirely. Instead, maintaining a disciplined, mechanized formula for asset allocation provides the necessary structure to navigate volatility, ensuring that decisions are driven by mathematical rebalancing rather than the unpredictable, often ruinous impulses of mass psychology. The pursuit of the recognized growth stock appears, at first glance, to be the most logical path to superior wealth. It seems inherently sensible to identify corporations that have historically compounded their earnings at a breathtaking pace and to align one's capital with their future dominance. However, this seemingly flawless logic conceals a devastating trap. The financial markets are spectacularly efficient at identifying these corporate champions, and the investing public reacts by bidding their shares up to exorbitant, unforgiving multiples. The buyer of a universally acknowledged growth enterprise pays such a massive premium for the anticipated future prosperity that the vital margin of safety is completely obliterated. The mathematical reality is that no trajectory of rapid, exponential expansion can be sustained indefinitely. As a corporation swells to gigantic proportions, the sheer physical and economic difficulty of multiplying its revenue deepens, inevitably causing the growth curve to flatten or decline. When an active allocator pays a steep multiple for a growth stock, they're essentially wagering that the future will unfold with absolute, unbroken perfection. If the enterprise suffers even a momentary operational hiccup, or if the growth rate merely slows to a normal pace, the market's reaction is often violent and merciless, resulting in a catastrophic destruction of capital. The sheer difficulty of consistently identifying growth stocks before the market fully prices them is evidenced by the performance of the most prestigious institutional funds. Armed with vast research departments and brilliant analytical minds, funds specifically dedicated to the growth stock approach routinely fail to consistently outperform the broader, unmanaged market averages over extended periods. Therefore, the aggressive pursuit of highly priced, widely recognized growth equities is a treacherous endeavor, demanding an almost impossible level of prophetic accuracy. To secure returns that genuinely exceed the ordinary, the enterprising allocator must deploy strategies that possess a twofold merit. They must be structurally and objectively sound, and they must be fundamentally unpopular on Wall Street. The first of these proven avenues involves the acquisition of large, prominent corporations currently suffering from deep market neglect. The market suffers from a chronic, institutionalized inability to maintain perspective, consistently overvaluing the glamorous industries of the moment while brutally punishing massive companies enduring temporary operational difficulties. By focusing on these entrenched titans when they are out of favor, the allocator secures a profound advantage. These enterprises possess the vast capital reserves and intellectual firepower necessary to weather the storm and correct their operational course. Because they are large and closely monitored, the market routinely responds with swift, dramatic upward revaluations the moment the earnings picture begins to brighten, rewarding the patient owner who acquired the shares during the period of maximum pessimism. The second avenue requires the meticulous, relentless identification of genuine bargains. A true bargain is an asset trading at a severe, demonstrable discount to its intrinsic, appraised worth. Specifically, an equity priced at 50% or less of its underlying value. These lucrative anomalies are frequently birthed by the market's tendency to exaggerate minor setbacks into existential crises or through periods of protracted, unjustified neglect. The most reliable, mathematically pure bargain is the equity trading for less than its net working capital alone. In these extraordinary scenarios, the buyer effectively pays nothing for the corporation's physical infrastructure, its machinery, its real estate, and its brand equity. While the broader market often shuns these secondary companies, assuming their diminished valuations portend ultimate bankruptcy, the historical reality is that the overwhelming majority of these businesses survive and eventually recover. Their deeply discounted acquisition prices offer a profound margin of safety, transforming them from market outcasts into highly lucrative, structurally protected investments. The third recommended field involves the highly technical, demanding realm of special situations, often referred to as workouts. This encompasses the meticulous exploitation of specific corporate events, such as mergers, acquisitions, liquidations, and complex reorganizations. The strategy relies on identifying and capturing the mathematical discrepancies between the current market quotation and the ultimate promised payout of the corporate action. While historically this arena provided a dependable source of robust, non-correlated returns, the landscape has evolved into a fiercely competitive, treacherous domain. The sheer proliferation of corporate conglomerates and the escalating frequency of aborted failed mergers demand that the participant possess an almost professional level of legal and financial expertise to successfully navigate the heightened risks of non-consummation. The ultimate success of capital allocation demands a stark, unyielding choice regarding one's posture. There is no viable, comfortable middle ground between the passive and the active paths. Attempting to be a half-hearted business person guarantees only a fraction of the necessary reward, accompanied by a disproportionate amount of risk. The overwhelming majority of the public must accept the defensive role, embracing the profound safety and peace of mind found in standard, unexciting portfolios. For the rare individual possessing the intellect, the rigorous training, and the relentless drive to pursue the active path, their financial operations must be conducted with the exact same cold calculation applied to running a traditional commercial enterprise. Investing is most intelligent when it is most businesslike. The enterprising allocator must thoroughly understand the underlying economics of their assets, refusing to attempt to extract abnormal profits without possessing a mastery of the subject matter. They must refuse to delegate the authority over their capital to others unless they possess absolute, verified confidence in their advisor's integrity and ability. Every operation must be grounded in reliable arithmetic that demonstrates a mathematical probability of profit, resolutely rejecting ventures built on blind optimism or those that offer meager upside against the threat of substantial loss. Finally, the true investor must possess the unwavering courage to act upon their own reasoned conclusions. When rigorous analysis and unyielding logic dictate a course of action, the intelligent mind proceeds with absolute conviction, remaining perfectly serene and unshaken even when the roaring, hysterical crowd vehemently disagrees. To the enterprising allocator and the defensive participant alike, the actions deliberately avoided bear as much weight as the actions aggressively pursued. In a utopian financial landscape, the intelligent mind would seamlessly acquire equities at their absolute nadir, effortlessly liquidate them as they breach the threshold of overvaluation, and retreat into the impregnable sanctuary of fixed-income instruments until the cycle resets. The intoxicating allure of this concept, commonly known as market timing, is perpetually fueled by retrospective academic studies demonstrating the staggering wealth that could be amassed by simply sidestepping the market's darkest days. Yet, this seductive premise is anchored entirely in the realm of sleight of hand. The fundamental impossibility lies in identifying those catastrophic days before the dawn breaks. financial history is replete with the shattered prophecies of the most revered economic minds, including future central bankers, who confidently heralded unprecedented bullish environments mere days before the onset of the most agonizing, protracted economic contractions. Rigorous examinations of elite market timing publications confirm that their collective wisdom drastically underperforms the simple, passive retention of a broad market index. While the backward glance of hindsight offers flawless clarity, the forward gaze of the financial markets is legally and permanently blind, rendering the precise timing of market fluctuations an emotional and practical impossibility for the mortal investor. As we transition from the fallacy of timing to the mechanics of growth, we must confront the illusion of perpetual ascent. Much like a projectile accelerating through the stratosphere, celebrated growth equities often appear immune to the gravitational forces of economic reality. During periods of immense prosperity, dominant enterprises routinely report staggering, unbroken expansions in revenue and profitability. However, an insidious dynamic takes hold. The faster the enterprise expands, the more exorbitant its market quotation becomes. When the valuation of the equity outpaces the fundamental expansion of the commercial enterprise, the investor is invariably destined for sorrow. A magnificent business transforms into a catastrophic investment the moment an excessive premium is paid for its shares. The collective assumption that a rising equity will continue to rise in perpetuity is violently contradicted by the fundamental laws of financial physics. As a corporate entity swells to gargantuan proportions, the sheer mathematical burden of doubling its sales becomes insurmountable. The intelligent allocator recognizes that an exorbitant multiple of earnings severely tilts the odds toward disaster. The historical ledger proves that only a microscopic fraction of the largest corporations have ever managed to sustain a rapid double-digit growth rate for more than a decade. The inevitable deceleration of growth transforms heavily inflated shares into plunging stones. This perilous environment is frequently exacerbated by the architects of corporate strategy themselves, creating an atmosphere ripe for catastrophic hype. The delusion of infinite expansion is not solely the domain of the retail public. It frequently infects the highest echelons of executive leadership. During the frenzied peaks of the market, the leaders of vast telecommunications and technology empires publicly ridiculed the concept of valuation ceilings, boldly guaranteeing their shareholders decades of uninterrupted, explosive growth. They actively encouraged the market to assign triple-digit multiples to their earnings, citing visionary strategies and unparalleled execution. Yet when the inevitable economic contraction arrived, these same invincible empires bled tens of billions of dollars in red ink, and their once soaring equities collapsed to pennies on the dollar. The intelligent mind must recognize that when corporate stewards prioritize the promotion of their stock price over the sober management of their business operations, the potential for hype vastly outweighs the potential for sustainable profit. In the pursuit of extraordinary returns, one might be tempted by the ancient, aggressive mandate to concentrate all available capital into a single, intimately understood venture. The argument suggests that unparalleled wealth is forged by placing every egg into one basket and watching that basket with unwavering vigilance. Indeed, the genesis of nearly every monumental American fortune can be traced to a hyper-concentrated stake in a singular industry or enterprise. Yet, this narrative conveniently omits a chilling corollary. Immense concentration is also the primary architect of the most spectacular financial ruins. A rigorous review of the wealthiest individuals over a span of decades reveals a staggering rate of attrition. The vast majority of those who built fortunes through intense concentration eventually saw those fortunes decimated when the underlying economic tides shifted against their singular, unprotected basket. For the intelligent allocator, the preservation of capital must remain paramount, dictating that the catastrophic risks of extreme concentration must be fiercely rejected in favor of the protective shield of broad diversification. The true hunting ground for the enterprising mind lies not in the euphoric peaks of growth, but in the desolate valleys of the bargain bin. In an endlessly networked, instantaneously informed financial ecosystem, unearthing genuine, neglected value requires painstaking manual excavation. The intelligent search frequently begins by examining the roster of equities trading at their lowest valuations of the year, pointing the allocator toward unloved, unfashionable sectors brimming with potential once the dark clouds of perception inevitably part. By meticulously scrutinizing the dense, unglamorous footnotes of regulatory filings, the diligent analyst can identify enterprises trading for less than the pure liquid value of their working capital. In the immediate aftermath of a brutal market crash, these astonishing anomalies multiply. When an enterprise can be acquired for a total market capitalization that is lower than its available cash and inventory, the ongoing commercial operation is effectively being offered for free. While individual instances of these deep bargains may still languish or fail, a broadly diversified basket of these discarded assets provides the ultimate mathematical margin of safety, virtually ensuring a profitable outcome for the patient owner. Finally, the architecture of a sound portfolio must transcend domestic borders to establish a prudent foreign policy. The necessity of international diversification is starkly illustrated by examining the catastrophic consequences of supreme nationalistic confidence. An investor residing in a dominant, booming foreign economy during the late 20th century, witnessing their domestic market consistently crush global competitors and observing their national corporations acquiring vast swaths of overseas real estate, would logically conclude that their home market was the only rational harbor for their capital. Yet, over the subsequent decade, that supposedly invincible domestic market suffered a crushing multi-decade collapse, obliterating the wealth of those who refuse to look outward. The crucial lesson is not that domestic markets are inherently flawed, but that total, blind reliance on a single national economy is a dangerous act of hubris. Because the future remains permanently veiled, the intelligent allocator must prudently deploy a portion of their equity capital into foreign markets, ensuring that their financial destiny is not entirely captive to the unpredictable, localized risks of their own backyard. 1. The investor and market fluctuations. To the degree that an individual's capital is sheltered within high-grade obligations of relatively brief maturity, the erratic shifting of market prices will have a negligible impact, and the owner may comfortably ignore them. The same holds true for sovereign savings instruments that guarantee the return of principal. However, a portfolio composed of long-term debt will inevitably experience significant price swings over the course of its lifespan, and any collection of common equities is absolutely guaranteed to fluctuate in value over any span of several years. The intelligent allocator must intimately understand these possibilities and fortify themselves, both financially and psychologically, to endure them. There is a natural, perfectly legitimate desire to benefit from these shifting market levels, primarily through the long-term appreciation of the assets, but perhaps also by capitalizing on the opportunity to purchase at advantageous lows and sell at euphoric highs. Yet, this very desire harbors a profound danger, for it can effortlessly seduce the unwary mind into the perilous realm of speculation. The instruction to abstain from speculation is easily spoken. The monumental challenge lies in actually obeying it. Should one choose to gamble, they must do so with their eyes wide open to the overwhelming probability of ultimate loss, rigidly sequestering those speculative funds away from the serious business of investment. Market fluctuations as a guide to investment decisions. Because common stocks of even the highest investment grade are subjected to violent and recurring price oscillations, the intelligent participant naturally questions whether these pendulum swings can be systematically exploited. Two primary avenues exist for attempting this exploitation: the method of timing and the method of pricing. The pursuit of timing involves the ambitious endeavor to forecast the future trajectory of the stock market, deploying capital when the overarching trend is perceived to be upward, and liquidating or withholding capital when the trend appears to tilt downward. The pursuit of pricing, conversely, involves the disciplined effort to acquire equities only when they are quoted below their objectively determined fair value, and to distribute them only when they ascend above that intrinsic worth. For the defensive allocator, a less aggressive variation of pricing is simply ensuring that an exorbitant premium is never paid for an acquisition. The individual who dedicates their energy to pricing will ultimately derive highly satisfactory, enduring results. Conversely, the individual who obsesses over timing, who attempts to peer into the fog of the macroeconomic future, will inevitably degenerate into a mere speculator and will ultimately reap a speculator's dismal financial harvest. This fundamental distinction is frequently blurred in the popular imagination, and the brokerage establishment remains deeply, financially wedded to the illusion that market forecasting is a necessary and profitable activity. The financial landscape is flooded with daily prognostications, yet simple logic dictates that the general public can never reliably extract wealth from these predictions. If a universally broadcast signal prompts the entire crowd to sell for a profit simultaneously, who remains to purchase those shares? Expecting to achieve lasting wealth by following popular forecasting methodologies requires the absurd assumption that you can consistently outsmart the very crowd of which you are a part. The psychological underpinnings of timing reveal its true nature. The speculator is desperate to capture their profit with maximum velocity. The prospect of holding an undervalued asset for a year before it is recognized by the market is abhorrent to them. Yet, the true investor remains entirely indifferent to the passage of time, provided the underlying business remains sound. Delaying a purchase in the hope of a better market environment is only mathematically advantageous if the eventual discount acquired is substantial enough to fully offset the dividend income forfeited during the waiting period. The historical trajectory of renowned mechanical trading formulas perfectly illustrates the futility of timing. Certain highly publicized methodologies, which relied on identifying specific technical breakthroughs in the market averages to trigger automatic buying and selling, appeared to possess an almost magical infallibility when tested against the historical data of earlier eras. However, as these formulas gained widespread mainstream acceptance, their reliability began to rapidly decay. This deterioration occurs for two unavoidable reasons. First, the relentless passage of time inevitably introduces novel economic conditions that shatter the parameters of the old models. Second, the very popularity of a trading system destroys its efficacy. When an entire herd stampedes in the same direction based on a synchronized signal, the resulting market distortion becomes a profound hazard rather than a profitable advantage. Buy low, sell high approach. If forecasting the market's trajectory is a fool's errand, can the allocator instead profit from fluctuations after they have occurred by systematically acquiring equities in the desolate valleys of a bear market and liquidating them upon the euphoric peaks of a bull market? For the first half of the 20th century, the rhythmic cyclical nature of the financial markets strongly suggested that this was a viable, highly logical strategy. A procession of distinct market cycles, typically lasting a handful of years, swung back and forth with remarkable regularity. The great bull markets shared identifiable repeating characteristics: historically elevated price levels, exorbitant multiples of earnings, anemic dividend yields relative to premium bonds, a rampant expansion of margin debt, and an avalanche of poor-quality initial public offerings. It seemed entirely plausible that a shrewd observer could simply wait for these unmistakable warning signs to clear the market, and then re-enter during the subsequent inevitable despair. However, the unprecedented monolithic bull market that commenced in the late 1940s completely obliterated this historical rhythm. The market's behavior decoupled entirely from its past patterns, refusing to obey the established danger signals and endlessly frustrating those who stubbornly waited for a classic deep bear market to materialize. Whether the old predictable cycles of alternating euphoria and despair will ever permanently return is an unanswerable question. But it is fundamentally unrealistic to base a lifelong financial policy on the rigid expectation that the market will perfectly accommodate a strategy of waiting for catastrophic lows. The prudent approach accommodates these shifts not by attempting to predict the extremes, but by adjusting the proportional weighting of fixed income and equity assets based on the objective, prevailing attractiveness of market valuations. Formula plans. During the early stages of the great post-war market expansion, the financial community became captivated by various mechanical formula plans designed to conquer market cycles. The fundamental architecture of these strategies, excluding the simple, elegant discipline of dollar-cost averaging, dictated that the investor must automatically liquidate portions of their equity holdings as the broader market advanced. In many variations, a sufficiently large market surge would trigger the total, mandatory liquidation of all common stocks. This mechanized approach carried the intoxicating appeal of sounding both deeply logical and profoundly conservative, and it demonstrated flawless historical success when back-tested against previous decades. Tragically, its immense popularity peaked at the precise historical moment it was destined to fail most spectacularly. As the market embarked on its historic, multi-decade ascent, the rigid dictates of these formulas forced their adherents to liquidate their equities entirely. leaving them stranded in cash during one of the most magnificent wealth-creating eras in human history. The markets simply ran away from them, and their mechanized rules offered no mechanism for re-entry. This agonizing experience reinforces a timeless financial truth. Any methodology for extracting abnormal profits from the stock market that can be easily articulated and mindlessly followed by the masses is, by its very nature, too simplistic to endure. The pursuit of excellence in the financial markets, much like in philosophy, is inherently difficult precisely because it is rare. Market fluctuations of the investor's portfolio. Every individual who commits capital to common equities must embrace the absolute certainty that their holdings will fluctuate in value across the years. Even a conservatively constructed portfolio, exclusively restricted to the shares of massive, prominent, and impeccably financed corporations, will experience significant volatility. It is a mathematical probability, not a mere possibility, that a broad basket of sound equities will advance by 50% or more from their lowest point, and subsequently decline by an equivalent 1/3 from their highest point during any given 5-year period. The serious allocator recognizes that the manic, day-to-day vibrations of the stock ticker do not dictate their actual wealth. Yet the broader, sustained tidal movements of the market present profound psychological complications. A massive, prolonged advance in the value of one's portfolio is a legitimate cause for satisfaction, but it simultaneously introduces a potent temptation toward reckless behavior. The sensation of sudden wealth effortlessly breeds overconfidence and greed, whispering the dangerous suggestion that one should abandon caution and amplify their exposure at the exact moment the market has become most precarious. Stated plainly in text, the folly of buying more simply because prices are elevated seems obvious. In the intoxicating atmosphere of a roaring bull market, it requires an immense reservoir of willpower to resist the hysteria of the crowd. It is precisely to combat these deeply ingrained human vulnerabilities that a mechanized method for adjusting the portfolio's balance is so vital. By forcing the allocator to trim equities and acquire bonds as the market climbs, and to reverse the process as it falls, the formula provides a crucial psychological release valve. It channels the investor's nervous energy into constructive, disciplined action, offering the supreme satisfaction of knowing that their operations run in direct, calculated opposition to the emotional stampede of the general public. Business valuations versus stock market valuations. The impact of market volatility upon the owner's true financial standing must be evaluated through a dual lens. The holder of marketable equities occupies a unique hybrid status. On one hand, their position is perfectly analogous to a minority partner in a private, unlisted commercial enterprise. In this capacity, their ultimate financial destiny is determined entirely by the operational profitability of the business and the tangible expansion of its underlying assets. The value of this private stake would be rationally determined by examining the corporate balance sheet. On the other hand, the owner of public equities holds a highly liquid instrument that can be instantly exchanged for cash at a price that fluctuates wildly from minute to minute, often completely divorcing itself from the sober reality of the balance sheet. The modern evolution of the stock exchange has increasingly enslaved the investing public to the tyranny of these daily quotations, eroding the traditional mindset of business ownership. This shift occurred because the most celebrated, successful corporations now trade at massive permanent premiums to their tangible asset values. In paying these exorbitant premiums for the promise of future growth, the investor voluntarily surrenders their independence, becoming utterly reliant on the fickle mood of the stock market to validate their commitment. This dynamic creates a profound, built-in contradiction within the structure of market valuations. The more magnificent a corporation's record and future prospects, the less tethered its share price becomes to its actual, tangible book value. But as the premium above tangible assets expands, the foundation of its valuation becomes increasingly ethereal and subjective, dictated entirely by the shifting, unpredictable emotions of the crowd. Thus, we arrive at the ultimate financial paradox. The higher the quality and success of the underlying business, the more violently speculative and volatile its stock price becomes. The shares of the absolute greatest corporate champions routinely suffer catastrophic, percentage-crushing declines simply because the market suddenly loses faith in the astronomical premium it previously assigned to their future. This reality offers a vital, practical directive for the conservative mind. If one wishes to insulate their portfolio from the terrifying volatility of the market's mood swings, they must concentrate their acquisitions on equities trading at a reasonable proximity to their tangible asset value, perhaps capping the acceptable premium at 1/3 above book value. Acquisitions made at these grounded levels are logically tethered to the corporate balance sheet, possessing an intrinsic, demonstrable justification entirely independent of the market's daily hysteria. The modest premium paid can be viewed as a reasonable fee for the luxury of immediate liquidity. Naturally, proximity to asset value is not a solitary guarantee of safety. The enterprise must simultaneously demonstrate a robust ratio of earnings to price, an impregnable financial fortress, and a proven history of stable profitability. While this may seem a demanding prescription, such opportunities are readily abundant in all but the most dangerously inflated market environments. By willingly forsaking the thrilling but perilous pursuit of spectacular, above-average growth, the allocator can easily assemble a broad selection of businesses meeting these stringent criteria. The owner of such a grounded portfolio can adopt an attitude of sovereign detachment toward the manic fluctuations of the exchange. Provided the fundamental earning power of the enterprises remains intact, the vagaries of the market become entirely irrelevant, serving only as an occasional opportunity to execute the master stroke of buying at illogical depths and selling at euphoric heights. The A&P example, a historical examination of the great Atlantic and Pacific Tea Company, provides a fascinating, encapsulating view of the profound disconnect between corporate reality and market perception. At its zenith in 1929, the shares traded at an exorbitant height. Just 3 years later, amidst the depths of the Depression, the quotation had been pulverized, despite the company maintaining nearly its full earning power. By 1938, the shares had plummeted to an astonishingly dismal low. At this depressed valuation, the entire outstanding capitalization of the enterprise was priced at a figure significantly lower than the company's cash and working capital alone. The largest, most dominant retail operation on the continent was effectively being valued as if it were a dead, liquidated carcass, with no value assigned to its vast infrastructure or its immense, ongoing profitability. The market was consumed by temporary anxieties, fears of new taxation, a minor dip in recent earnings, and the pervasive gloom of the era. If a rational allocator had acquired the shares during this period, guided by the company's robust historical earnings and unshakable balance sheet, they would have been entirely justified in ignoring the terrifying market quotation as a temporary, irrational hallucination of finance. Sequel and reflections. In the very next year, the shares tripled in value, rectifying the market's absurd pessimism. Yet the story did not end there. Decades later, swept up in a new era of unbridled optimism, the shares reached a newly adjusted peak, trading at an astronomical, unjustifiable multiple of 30 times earnings. This valuation implied a brilliant exponential growth trajectory that was entirely unsupported by the company's actual, faltering historical record. Inevitably, the market's manic enthusiasm proved disastrously wrong, and the shares suffered a brutal, unrelenting collapse as the underlying business deteriorated into mediocrity. Two profound morals emerge from this corporate saga. First, the stock market is frequently spectacularly wrong, offering courageous, alert individuals the opportunity to capitalize on its patent absurdities. Second, the fundamental character and quality of a commercial enterprise are not static. They evolve and often decay over the decades. While the owner need not monitor their holdings with neurotic anxiety, they must subject the underlying business to rigorous, periodic re-evaluation. The true investor holds a definitive advantage over the private business owner, but only if they possess the psychological strength to utilize it properly. The holder of marketable shares is never forced to liquidate their position and is entirely free to ignore the daily cacophony of price quotations. They need only pay attention to the market when the prices offered serve their own strategic advantage. An individual who allows themselves to be terrified or stampeded into liquidation by an unjustified drop in the market price perversely transforms their greatest advantage, liquidity, into their most devastating liability. It is a profound truth that many individuals would be vastly wealthier if their equities possessed no daily market quotation whatsoever, for they would be spared the agonizing mental torture inflicted by the irrational pricing errors of the crowd. During the darkest days of economic depression, individuals holding unquoted real estate mortgages often felt secure in their wealth, shielded from panic by the simple absence of a fluctuating price tag. Simultaneously, individuals holding premium, highly secure corporate bonds suffered immense psychological anguish as the quoted prices of their assets collapsed, falsely convincing them that they were facing ruin. In reality, the bondholders were in a vastly superior financial position, possessing liquid assets that could be exchanged for even greater bargains. The illusion of safety provided by an unquoted asset is a dangerous self-deception, but the panic induced by a quoted asset is equally destructive. The liquidity provided by an organized exchange is not a mandate to act, it is merely an option. To understand this dynamic, imagine you own a stake in a private enterprise and your partner is a highly obliging, deeply neurotic individual named Mr. Market. Every single day, without fail, Mr. Market knocks on your door and informs you of precisely what he believes your stake is worth. Furthermore, he stands ready and willing to either buy you out completely or sell you an additional stake at that exact quoted price. On certain days, Mr. Market's valuation appears grounded in the sober economic realities of the business. However, Mr. Market suffers from incurable emotional instability. Frequently, he is swept up in blinding euphoria, seeing only infinite prosperity, and he quotes you a price that is ridiculously, dangerously high. On other days, he is consumed by terror, seeing nothing but impending doom, and he offers to sell you his stake for a pitiful, absurdly low fraction of its true value. If you are a prudent business person, will you allow the daily manic-depressive ravings of Mr. Market to dictate your own perception of the value of your enterprise? Absolutely not. You will only engage with him when his emotional extremes serve your calculated advantage. You will happily sell to him when his euphoria drives the price to an absurd premium, and you will eagerly acquire his stake when his despair drives the price to an irrational discount. For the remainder of the time, you will wisely ignore his chaotic noise, relying entirely on the cold, hard economic data generated by the business itself. The true investor occupies this exact position. The daily fluctuations of the stock ticker possess only one significant utility. They periodically create magnificent opportunities to acquire assets cheaply when the crowd panics, and to distribute assets profitably when the crowd becomes wildly greedy. At all other times, the intelligent mind is vastly better served by forgetting the stock market entirely and focusing solely on the dividend returns and the fundamental operating results of their corporate partnerships. Summary. The absolute defining boundary between the investor and the speculator is found entirely in their psychological posture toward market movements. The speculator is consumed by the desire to anticipate and profit from the immediate fluctuating direction of prices. The investor is dedicated to the methodical acquisition and retention of suitable enterprises at rational valuations. Market volatility is significant to the true allocator only because it serves as the mechanical engine that occasionally generates bargain prices for acquisition and eventually produces elevated prices for liquidation. It is a profound error to assume that the allocator should hoard cash indefinitely, waiting for a catastrophic bear market to present the perfect buying opportunity. Such a strategy risks missing years of dividend income and enduring protracted periods of capital stagnation. The most logical approach is to continuously deploy capital as it becomes available, pausing only when the overarching valuations of the broader market become mathematically unjustifiable by any sober standard. The financial establishment expends vast oceans of intellectual energy attempting to select the specific equities or sectors that will outpace the market over the next 12 months. This frantic competitive guessing game is structurally unsuited to the temperament of the true preserver of wealth. Because thousands of brilliant, highly compensated professionals are simultaneously engaged in this exact same pursuit, the effort becomes entirely self-neutralizing and ultimately self-defeating. The individual anchored to a portfolio of sound businesses must expect inevitable, sometimes violent price fluctuations, refusing to be paralyzed by the declines or intoxicated by the ascents. The ultimate maxim for the intelligent mind is this: never acquire an asset simply because its price has surged, and never discard an asset simply because its price has plummeted. An added consideration. A final, vital element must be acknowledged regarding the significance of market quotations. The ultimate gauge of managerial competence is not merely the generation of corporate profit, but the reflection of that profit in the long-term, average market value of the shares. Corporate executives routinely claim that they have no control over the stock price and bear no responsibility for its fluctuations. While they cannot be blamed for the irrational temporary mood swings of Mr. Market, the permanent establishment of a chronically depressed, unsatisfactory valuation is a direct indictment of the leadership. Only the apathy of the investing public allows this immunity to persist. Competent management naturally produces a robust, satisfactory average market value. Chronically poor market prices are the undeniable signature of chronically poor management. Fluctuations in bond prices. The allocator must remain fully aware that even the most impregnable, sovereign-backed debt instrument will experience significant volatility in its market quotation if it possesses a long-term maturity. This volatility is the direct mathematical result of fluctuating macroeconomic interest rates. Historical data reveals that premium corporate and tax-free municipal bonds have endured periods of agonizing, unprecedented price collapse, completely wiping out the assumed stability of the asset class. The inverse relationship between bond yields and bond prices dictates that as prevailing rates rise, the principal value of existing debt must fall, while the fixed maturity value provides a moderating anchor. The price of very long-term debt can swing with terrifying violence. The financial landscape of the late 1960s and early 70s produced the most extreme, staggering fluctuations in bond prices in recorded economic history, serving as a brutal reminder that the laws of financial gravity are never suspended. The vital lesson is that no phenomenon in the financial markets can be guaranteed to replicate its past behavior with perfect precision, because predicting the future trajectory of interest rates is an impossible, futile endeavor. The allocator must structure their fixed income portfolio based on their personal tolerance for principal volatility. If absolute stability of principal is the paramount requirement, the portfolio must be restricted to short-term instruments or specialized sovereign savings bonds. If the allocator desires the robust yields offered by long-term corporate or municipal debt, they must psychologically prepare themselves to watch the market value of those assets fluctuate significantly. The realm of convertible bonds introduces a chaotic, triply complex layer of volatility. The price of a convertible issue is battered simultaneously by the shifting quotation of the underlying common stock, the evolving creditworthiness of the issuing corporation, and the macroeconomic movements of general interest rates. Because many of these instruments are issued by companies with less than stellar financial foundations, they are deeply vulnerable to economic contractions. The investor who seeks the holy grail of absolute bond-like safety combined with the limitless upside of equity participation within a single convertible instrument is engaging in a dangerous self-delusion. The collective haggling of countless participants generally establishes a reasonably accurate valuation for the majority of businesses. Yet periodically, the pricing mechanism breaks down entirely, producing valuations that are profoundly disconnected from reality. It is during these manic episodes that the brilliant allegory of a volatile business partner comes into sharp focus. This hypothetical partner does not appraise a business through the sober, calculating lens of a private acquirer. Instead, his valuations are driven by extreme emotional swings, paying absurd premiums during fits of euphoria and offering to liquidate at staggering discounts during bouts of depression. This bipolar behavior remains a permanent fixture of the financial landscape. Consider the meteoric rise of a young digital enterprise at the dawn of the new millennium. Despite possessing no historical profitability and hemorrhaging cash at an alarming rate, the market became violently infatuated with its surging revenues, assigning it a multi-billion-dollar valuation that defied all economic gravity. When the euphoria inevitably evaporated, the market violently reversed course, crushing the valuation to a microscopic fraction of its former peak, even as the company continued to generate substantial revenue. Ultimately, a larger competitor acquired the shattered enterprise for a pittance, capitalizing on the market's manic depressive pricing. No rational individual would ever permit a deeply unstable acquaintance to dictate their emotional state or financial decisions on a daily basis. One would fiercely defend their right to independent judgment, yet millions of participants willingly surrender their psychological autonomy to the erratic whims of the stock exchange. When the market plunges, the public reflexively mimics the prevailing panic, halting their automated investment programs exactly when assets are cheapest. The intelligent allocator must absolutely refuse to be enslaved by these external mood swings. The market's sole function is to provide a menu of prices. The allocator retains the ultimate power to accept or reject those offerings based entirely on their own calculated advantage. By asserting this independence, the market is transformed from a tyrannical master into a highly useful servant. Even as it relentlessly destroys the paper wealth of overvalued glamour stocks, it simultaneously creates profound bargains elsewhere, pushing the prices of established, unfashionable businesses down to irresistible depths. The ultimate advantage possessed by the individual allocator is the absolute freedom to think independently and act patiently, a luxury entirely denied to the professional money manager. The institutional professional is permanently shackled to the erratic footsteps of the market, forced to buy inflated assets when public cash floods their coffers and compelled to liquidate holdings during panics when the public demands redemption. Their massive size restricts them to acquiring only the most prominent, heavily traded corporations, forcing them to mimic their competitors in a sluggish, identical herd. Furthermore, their compensation structures demand relentless short-term performance, making career preservation the paramount goal rather than independent, contrarian value creation. Attempting to defeat these professionals by adopting their own flawed, hyperactive methodologies is a guaranteed path to ruin. Instead, the intelligent allocator must conquer themselves, rigorously controlling the elements within their grasp, minimizing frictional trading costs, refusing to pay exorbitant management fees, maintaining realistic expectations, strictly governing their asset allocation, and executing their strategy with unyielding emotional discipline. The ultimate measure of triumph is not outperforming an arbitrary index or a faceless competitor, but successfully navigating one's own financial plan to its intended destination. The seductive power of market fluctuations is rooted deep within the neurological architecture of the human mind. The brain is instinctively wired to recognize patterns, anticipating continuations even in entirely random sequences. When an asset advances repeatedly, neurological chemistry releases a euphoric reward, addicting the individual to the intoxicating illusion of predictable momentum. Conversely, financial loss triggers a primal, overwhelming fear response, a biological alarm system that completely short-circuits rational analysis. Behavioral studies confirm that the psychological agony of losing capital is vastly more intense than the pleasure derived from an equivalent gain, frequently paralyzing the individual and preventing them from capitalizing on deeply discounted opportunities. This biological vulnerability explains why participants fixate on the terrifying, absolute point drops of market indices, completely losing sight of the relatively minor percentage declines they actually represent. The constant, obsessive monitoring of portfolio values only exacerbates this neurological torment. The true preserver of wealth recognizes that over a multi-decade horizon, the manic daily vibrations of the market are utterly meaningless. By acknowledging their own biological susceptibility to fear and greed, the intelligent mind deliberately binds itself to the mast of automated, disciplined purchasing, permanently neutralizing the destructive impulses of human nature. Imagine a financial broadcast that reported market contractions not with sirens and panic, but with the celebratory fanfare of a massive discount sale. In this rational utopia, a plunging index would be heralded as magnificent news for the long-term accumulator of assets, celebrating the fact that ownership stakes in premier businesses were suddenly available at drastically reduced prices. Pundits would cheerfully hope for further declines, recognizing that a prolonged bear market is the absolute greatest ally of the disciplined automated buyer. While the central doctrine dictates that capital should be deployed when the crowd is panicking, a singular, powerful exception exists. Liquidating an asset during a severe market contraction can be highly advantageous if it generates a substantial tax windfall. The Revenue Code permits the realization of capital losses to offset taxable income. By deliberately crystallizing a loss, waiting the legally mandated period, and subsequently repurchasing the same or a similar asset, the allocator effectively forces the government to subsidize their misfortune. This maneuver lowers the individual's tax burden while allowing them to maintain their ownership stake in a fundamentally sound enterprise at a freshly discounted cost basis, transforming a paper loss into a tangible, strategic victory. The ultimate commitment to financial rationality can be formalized through a binding psychological covenant with oneself. This solemn pledge demands the continuous automated accumulation of diversified assets over a horizon stretching across decades, explicitly rejecting the frantic emotional dictates of the crowd. The signatory vows never to acquire an asset simply because its price has surged, nor to abandon a holding simply because its quotation has plummeted. By establishing strict, predefined exemptions for genuine financial emergencies and refusing to yield to the seductive noise of the market, the individual effectively signs a declaration of absolute financial independence, securing their capital against the most dangerous enemy of all, their own impulsive nature. Chapter 9. Investing in Investment Funds. A perfectly viable and historically sound alternative for the defensive allocator is to entrust their capital to the stewardship of investment companies. These entities serve to aggregate the wealth of the public and deploy it across a diversified landscape of securities. The structural architecture of these organizations generally divides into two distinct camps: The first, the open-end or mutual structure, constantly issues new shares and redeems existing ones based upon the exact calculated value of the underlying assets. The second, the closed-end structure, operates with a fixed, unchanging number of shares that trade upon the public exchanges exactly like the equity of any standard commercial corporation, with their prices dictated entirely by the shifting tides of supply and demand. The participant navigating this arena faces a bewildering array of choices, from entities demanding a hefty, immediate sales commission to those operating purely on internal management fees, alongside specialized portfolios targeting everything from absolute stability to aggressive capital appreciation. Furthermore, these organizations occupy a unique realm of taxation designed to pass the burdens and benefits of ordinary income and realized capital gains directly through to the individual shareholder. The paramount question confronting the intelligent mind is whether entrusting capital to these professional stewards reliably produces outcomes superior to the broader, unmanaged market. Viewing the industry through a wide, historical lens, one must concede that these institutions perform a profoundly beneficial societal function. They have introduced millions of individuals to the disciplined habits of saving and diversification, successfully shielding the uninitiated from the catastrophic, concentrated blunders that frequently decimate amateur portfolios. It is highly probable that the average citizen who committed their resources exclusively to these diversified funds fared significantly better than the individual who attempted to navigate the treacherous waters of direct equity ownership without adequate training. This remains true even if the funds themselves failed to decisively conquer the market averages. The genuine alternative for the general public has rarely been a choice between a flawlessly executed personal portfolio and a mutual fund. Rather, it has been a choice between the relatively safe harbor of professional diversification and the terrifying, wealth-destroying allure of speculative, highly promoted stock peddlers. Yet, when subjecting the aggregate performance of these professional managers to rigorous statistical scrutiny, a sobering reality emerges. As a collective entity, these funds do not reliably outperform the broad market indices. They mirror it. This mathematical mediocrity is not necessarily a harsh indictment of the manager's intellect, but rather a reflection of their sheer, overwhelming size. Because these institutions control such a massive, dominant proportion of all circulating equities, their collective decisions effectively dictate the movements of the market itself. A financial entity cannot consistently outpace the very benchmark it constitutes. Furthermore, the intuitive strategy of simply identifying the specific funds that boast the most spectacular recent track records and pouring capital into them on the assumption that such brilliance is a permanent fixture is a strategy doomed to frustration. Exceptional historical performance is frequently the product of a manager temporarily aligning with a specific, fleeting market fashion, rather than possessing a repeatable, enduring genius for valuation. This brings us to the perilous phenomenon of the performance cult, a movement that periodically captures the imagination of the financial establishment. During the intoxicating terminal stages of a prolonged economic expansion, a new generation of aggressive, highly publicized money managers inevitably emerges, promising to shatter the mundane returns of the traditional averages. Their methodology rarely involves the painstaking, conservative accumulation of undervalued assets. Instead, it relies on the reckless concentration of capital into the most glamorous, excessively priced equities of the moment, seeking rapid capital appreciation by anticipating the speculative enthusiasm of the uninformed public. For a brief, dazzling interlude, these maneuvers can generate breathtaking, almost miraculous paper profits, catapulting their architects to the status of financial deities. However, the architecture of these spectacular returns is fundamentally fragile, built upon the quicksand of astronomical valuations and deeply unproven enterprises. When the inevitable economic contraction arrives, and the market's euphoric mood violently sours, the destruction inflicted upon these performance vehicles is absolute. The devastating losses suffered by the participants in these highly leveraged, conceptually flawed funds serve as a brutal, timeless reminder. Whenever professional managers abandon the strict mathematical disciplines of a margin of safety in favor of chasing short-term speculative momentum, the ultimate result is always a catastrophic evaporation of wealth. The promise of financial miracles executed with other people's money is an ancient illusion, one that repeatedly ends in tears and shattered portfolios. When evaluating the structural vehicles available for capital deployment, a glaring, persistent pricing anomaly exists between the open-end and closed-end models. Because open-end companies rely on vast, heavily compensated sales forces to aggressively market their shares, the public is routinely persuaded to acquire these assets at a significant immediate premium above their actual underlying net worth. Conversely, the shares of closed-end companies, lacking this relentless promotional machinery, frequently languish on the open market, trading at substantial, undeniable discounts to the exact same type of underlying assets. For the rational calculating allocator, this presents one of the few genuinely indisputable rules of selection. By acquiring a diversified basket of closed-end shares at a 10 to 15% discount from their intrinsic asset value, the investor mathematically secures a far greater claim on underlying corporate wealth than by surrendering a 9% premium to acquire an open-end equivalent. The familiar counter-argument that the discount on the closed-end shares might widen further, trapping the investor, collapses under the weight of basic arithmetic. The initial, permanent forfeiture of capital demanded by the open-end sales charge creates a massive mathematical handicap. A closed-end discount would have to widen to historically unprecedented, virtually impossible extremes before the long-term return of the discounted asset degraded to the level of the premium-priced fund. Therefore, the intelligent participant seeking professional stewardship should exhibit a profound, unwavering preference for the discounted closed-end structure. Finally, the concept of the balanced fund, which permanently commingles equities and fixed income obligations within a single portfolio, demands a critical, skeptical reassessment. While the premise of a unified, professionally maintained balance appears highly convenient, it represents a fundamentally inefficient allocation of resources. The fixed income segment of these portfolios generates a relatively modest, stable yield, which is then continuously diluted by the ongoing management and administrative fees extracted by the fund sponsors. The defensive individual is vastly better served and mathematically enriched by cleanly separating these functions. By directly acquiring premium, risk-free sovereign debt or high-grade municipal bonds for their fixed income allocation, the investor completely bypasses the unnecessary, corrosive friction of administrative costs, maximizing their yield while reserving the vehicle of the investment fund strictly for the management of their equity exposure. The creation of the mutual fund stands as a monumental triumph of financial democracy, a uniquely accessible vehicle that has ushered millions of everyday individuals into the realm of corporate ownership. By offering broad diversification, regulatory oversight, and professional stewardship at a relatively modest entry point, these pooled investments have shielded the public from the devastating, concentrated blunders that so often destroy amateur portfolios. Yet, it is vital to recognize that these instruments are only almost perfect. Embedded within their structure are profound imperfections, excessive administrative costs, severe tax inefficiencies, and violently erratic performance swings that demand the utmost vigilance from the intelligent allocator. The most common and destructive error committed by the investing public is the reflexive pursuit of recent outperformance. The human brain is biologically wired to seek patterns, naturally assuming that a vehicle ascending rapidly today will continue its vertical trajectory indefinitely. We expect financial stewards to operate like skilled artisans or athletes, where past excellence guarantees future brilliance. However, the financial markets are a realm where short-term luck vastly overshadows genuine skill. A manager who happens to be heavily concentrated in the most euphoric sector of a raging bull market will appear as a visionary genius, only to look entirely foolish when that specific sector inevitably turns ice cold. The academic consensus on this matter is absolute and unrelenting. Purchasing a fund based purely on its recent glittering track record is a fundamentally irrational act. The data proves that the average active manager fails to overcome the immense frictional costs of their own trading and research. Furthermore, the true predictors of future failure are not past triumphs but rather high expenses, hyperactive portfolio turnover, and extreme volatility. To understand why yesterday's absolute champions so frequently become tomorrow's profound disappointments, one must examine the destructive forces of success itself. The first hazard is the migration of talent. A manager who achieves spectacular returns is instantly coveted by rival institutions, frequently abandoning the very shareholders who entrusted them with their capital. Far more insidious is the disease of asset elephantiasis. When a portfolio posts breathtaking numbers, the public responds by flooding the gates with billions of dollars in new capital. This massive, sudden influx paralyzes the manager. They are forced to either hold the new capital as unproductive cash diluting the returns of a rising market, or funnel it into their existing holdings, dangerously inflating the valuations of those specific equities. Alternatively, the manager must desperately search for new, unproven ideas, spreading their intellectual focus far too thin. The nimble, decisive maneuvers that generated the initial success become physically impossible when navigating a portfolio bloated by public adulation. As the sheer size of the fund swells, the frictional costs of trading massive blocks of shares inevitably escalate, quietly eroding the underlying returns. Simultaneously, a profound psychological shift occurs within the management team. The massive pool of assets generates incredibly lucrative, guaranteed fee income for the sponsoring institution. To protect this revenue stream, managers become deeply risk-averse and highly imitative. They succumb to sheepish behavior, abandoning the bold, contrarian ideas that originally fueled their success and instead mindlessly herding into the exact same predictable, mega-capitalization equities held by every other major institution. They realize that mimicking the broader market protects their careers while daring to be different risks, catastrophic failure, and the loss of their massive fees. The ultimate, unassailable antidote to this cycle of high costs and behavioral decay is the broad market index fund. By permanently holding the entirety of the corporate landscape and completely abandoning the costly, futile pretense of predicting which specific equities will triumph, the index fund operates with rock-bottom administrative expenses and virtually zero trading friction. Over a multi-decade horizon, this compounding mathematical advantage is utterly insurmountable for the vast majority of highly compensated professionals. The single glaring flaw of the index fund is its terminal monotony. It offers absolutely no thrilling narratives and deprives the owner of the ability to boast about discovering the next revolutionary enterprise at a social gathering. Yet for the disciplined mind, this boredom is the precise mechanism of ultimate financial victory. If an allocator absolutely insists upon venturing into the realm of active management, they must ruthlessly screen for the rarest of traits. The prospective managers must treat the capital exactly as their own, possessing massive personal stakes in the portfolio to ensure their financial destiny is permanently lashed to the outside shareholders. The enterprise must be fanatically cheap, recognizing that while spectacular returns are fleeting, exorbitant fees are permanent. The portfolio must demonstrate a daring, independent architecture, bearing little resemblance to the predictable components of the standard market indices. The sponsoring institution must possess the extraordinary courage to close the fund to new investors before a flood of cash destroys the underlying strategy. Finally, the most reliable stewards operate in quiet diligence, entirely avoiding the vulgarity of financial television and relentless retail advertising. The allocator must also navigate the nuances of structural formats. While the universe of diversified closed-end equity funds has largely withered, the closed-end structure remains highly viable in the realm of municipal debt, where acquiring assets at a steep discount to their intrinsic value amplifies the underlying yield. The modern advent of exchange-traded funds offers vast, instantaneous exposure to specific sectors and broad markets, but they harbor the hidden peril of transactional commissions, rendering them deeply unsuitable for the defensive investor engaged in the relentless, incremental deployment of capital through dollar-cost averaging. Once a relationship with a professional steward is established, the allocator must exercise profound patience, recognizing when to hold firm and when to sever ties. Firing a manager simply because their specific disciplined style of investing temporarily falls out of market favor is a catastrophic error, guaranteeing that the investor locks in a period of underperformance while completely missing the inevitable cyclical recovery of that strategy. The true catalysts for liquidation are structural and behavioral. A sudden, inexplicable drift away from the fund's stated philosophy, a greedy escalation of management fees, the generation of massive, toxic tax liabilities through frantic trading, or a violent, uncharacteristic surge in the portfolio's volatility. Ultimately, navigating the world of professional stewardship requires conquering the deep-seated psychological illusion of control. The human mind possesses a boundless, inherent capacity for overconfidence, routinely convincing individuals that their financial acumen and resulting returns are vastly superior to objective reality. While this innate optimism is a necessary survival mechanism in daily life, it is a lethal handicap in the realm of capital allocation. Entering into a relationship with an investment fund requires a solemn, almost marital commitment to the underlying philosophy. If the allocator lacks the psychological endurance to withstand several lean, agonizing years of underperformance, the initial commitment should never be made. In the pursuit of delegated wealth creation, unyielding patience and a profound humility regarding one's own predictive abilities remain the investor's most formidable weapons. Chapter 10. The Investor and His Advisors. The allocation of capital within the financial markets occupies a highly unique position within the broader realm of commerce, primarily because it is an endeavor so frequently reliant upon the counsel of others. The vast majority of those who participate in the markets are essentially amateurs, and it is entirely natural for them to seek the guiding hand of a professional. Yet, a profound and often unrecognized paradox lies at the very heart of this relationship. When an individual seeks financial advice with the explicit goal of generating a profit, they are essentially asking a stranger to reveal the secret of wealth creation. This expectation is fundamentally naive. In traditional commercial enterprises, a business owner may consult an expert on matters of legal compliance or engineering, but they would never expect a consultant to simply hand them a guaranteed profit. Profit generation is the business owner's own domain. When individuals expect financial advisors to effortlessly manufacture abnormal returns on their behalf, they are demanding a miraculous outcome that has absolutely no equivalent in standard business practice. If we approach the deployment of capital with the sober expectation of securing normal, standard results, a conservative preservation of principal coupled with an adequate dividend and interest yield, the true function of the advisor becomes magnificently clear. The legitimate professional utilizes their extensive training and experience to shield the client from devastating, avoidable errors, ensuring that the capital yields the exact, standard return it naturally deserves. It is only when the client demands a spectacular, market-crushing performance, or when the advisor arrogantly promises to deliver such a miracle, that the fundamental integrity of the relationship is shattered. Guidance can be sought from a diverse array of sources: an ostensibly knowledgeable relative, a local commercial banker, a bustling brokerage house, a syndicated financial service, or a dedicated investment counsel firm. The sheer variety of these avenues suggests that the investing public has not yet crystallized a logical, systematic method for securing advice. The foundational thesis of seeking counsel is this: if an individual intends to rely predominantly upon the judgment of others, they must strictly confine both themselves and their chosen advisors to the most conservative, standard, and unimaginative investment vehicles available. To entertain unconventional, aggressive strategies recommended by an outsider, the individual must have evolved their own knowledge and experience to a level where they are fully competent to independently audit and approve those complex recommendations. At that point, they have fundamentally transitioned from a defensive posture to an enterprising one. The most authentic professionals in the advisory realm, the established investment counsel firms who exact a substantial recurring fee for their services, operate with a refreshing, almost ascetic modesty regarding their capabilities. They harbor no pretensions of market clairvoyance. Rather, they direct their clients' wealth almost exclusively into standard, interest-bearing sovereign and municipal debt, alongside the dividend-paying equities of the nation's most entrenched corporations. They make absolutely no attempt to navigate the treacherous, unpredictable tidal swings of the broader market. These prestigious firms pride themselves not on brilliant, speculative triumphs, but on rigorous care, unwavering conservatism, and absolute competence. Their overarching mandate is the steadfast preservation of principal and the generation of a respectable income. Any capital appreciation achieved beyond that baseline is viewed as a welcome, incidental bonus rather than a guaranteed deliverable. Their ultimate value resides in the impenetrable wall they build between their clients and catastrophic financial mistakes, offering the exact, sober stewardship that a defensive allocator has every right to demand. This same prudent philosophy generally governs the trust and advisory departments of major banking institutions. Operating on a different tier are the financial services, organizations that disseminate uniform bulletins, market analyses, and telegraphic updates to a broad base of subscribers. These services are considerably less expensive than personalized investment counsel and are directed primarily toward individuals who intend to actively pilot their own financial affairs. A significant portion of these syndicates dedicate their energies almost entirely to the dark art of market forecasting, utilizing arcane technical charts to predict short-term price movements. The intelligent allocator will dismiss these speculative efforts entirely, as they possess no relevance to the genuine preservation and growth of capital. Conversely, the most reputable of these services function as the statistical backbone of the financial community, compiling the voluminous, exhaustive corporate data upon which all serious security analysis relies. Because their subscriber base ranges from the most rigid conservative to the most reckless speculator, these organizations struggle to maintain a unified, coherent philosophy of valuation. They are commercially compelled to address the speculative hunger of the active trading public, offering market forecasts that are invariably hedged with ambiguous, Delphic phrasing designed to protect the publisher from being proven completely wrong. The intelligent mind will recognize that this forecasting apparatus exists simply because human nature relentlessly demands to be told what the future holds, not because the forecasts themselves possess any actual validity. While their macroeconomic interpretations and statistical compilations are invaluable, their recommendations on specific equities frequently suffer from a pervasive, superficial flaw. They are chronically prone to advising the purchase of a security simply because its near-term business prospects appear favorable, or advising its sale because the immediate horizon looks cloudy, utterly disregarding the prevailing market price of the asset. This myopic focus on the next 12 months prevents them from performing the true, rigorous work of analysis, determining whether the current quotation represents a severe overvaluation or a profound bargain relative to the company's long-term intrinsic earning power. Therefore, the intelligent participant will never blindly execute a transaction based solely on a service bulletin, utilizing these publications strictly as a repository of raw data and preliminary suggestions rather than absolute mandates. The most overwhelming volume of financial guidance is disseminated by the brokerage houses, the institutions that execute public orders upon the major exchanges in exchange for a commission. Nearly all of these firms maintain extensive analytical departments that distribute a vast array of literature and specific recommendations to their customers entirely free of charge. A profound ethical distinction is at stake in the subtle difference between referring to these individuals as customers versus clients. While the brokerage fraternity generally adheres to a high standard of business conduct, it struggles immensely to achieve the elevated, uncompromised standing of a true profession. Historically, Wall Street has thrived on the sheer volume of public speculation, an activity that mathematically condemns the participants to ultimate loss. To operate as a pure, uncompromised profession, the brokerage houses would be required to actively discourage this speculation, an act that would drastically diminish their own revenues. The most conservative firms attempt to navigate this conflict by refusing to peddle speculative tips, confining themselves to the execution of orders and the dissemination of sober, value-based analysis. Yet the overwhelming majority of firms succumb to the commercial reality that their most profitable customers desperately crave speculative excitement. Consequently, the machinery of the typical brokerage is deeply geared toward generating short-term trading volume, effectively assisting the public in an endeavor where they are destined to fail. The individual investor interfaces with the brokerage house through the customer's broker, an account executive whose livelihood is entirely dependent upon generating commissionable trades. While these individuals are heavily regulated and generally possess strong financial knowledge, their compensation structure makes it almost impossible for them to remain entirely immune to the speculative atmosphere. To protect themselves, the rational allocator must be unmistakably explicit in their interactions, clearly demonstrating that they are exclusively interested in the sober valuation of businesses and are entirely immune to the allure of market tips. Once the account executive recognizes they are dealing with a disciplined, value-minded owner, they will generally respect that posture and provide highly cooperative service. Operating behind the scenes is the financial analyst, the professional tasked with dissecting corporate balance sheets, comparing industrial rivals, and formulating expert opinions on the intrinsic value and safety of various securities. By a strange historical quirk, the title of security analyst originally carried no formal regulatory requirements, contrasting sharply with the stringent licensing demanded of the customer's broker. This discrepancy is currently being rectified through the establishment of rigorous academic certifications designed to elevate the discipline to the exact same professional and ethical standing as certified public accountancy. The ultimate utility of the brokerage analyst to the individual investor depends entirely upon the nature of the questions being asked. If the public constantly demands to know if a specific stock is poised to advance in the coming weeks, the analyst is forced to abandon deep valuation and keep one eye nervously fixed upon the ticker tape, a posture completely antithetical to sound financial judgment. However, if the investor clearly communicates that their sole objective is to acquire demonstrable underlying value with an adequate margin of safety, the highly trained analyst can be an instrument of immense, profitable assistance. The structural integrity of the brokerage establishment itself experienced a terrifying crisis at the dawn of the 1970s, witnessing the unprecedented bankruptcy or near collapse of several massive, historically prestigious firms. This systemic embarrassment was initially blamed on the sheer, crushing volume of trading that overwhelmed back-office facilities, and later on the sudden contraction of that very same volume. However, the darkest, most plausible explanation lay in the reckless deployment of the firm's own capital. It became evident that senior partners had been aggressively speculating with the firm's protective capital, hoarding highly inflated, unproven equities. When the market inevitably plunged, this capital vanished, destroying the very foundation intended to protect the public's assets. This inexcusable behavior necessitates a rigid, ultra-conservative protocol for the individual. Until the brokerage industry fully resolves these structural weaknesses, the non-professional investor should absolutely refuse to maintain a margin account and should instruct their broker to deliver all purchased securities directly to their personal bank against payment. This incurs a minor administrative expense, but the resulting peace of mind and absolute physical security of the assets are paramount. The investment banking houses, which underwrite and distribute newly minted bonds and equities, occupy the most vital, constructive sector of the financial community, serving as the conduit for the capital that fuels industrial expansion. However, the relationship between the underwriter and the public is fundamentally that of a highly motivated salesman and a prospective buyer. When distributing premium corporate debt to massive, sophisticated financial institutions, the transaction is conducted on a rigorous, mutually calculating basis. But when these same banks float new common stock issues to an inexperienced retail public desperate for rapid profits, the dynamic is deeply perilous. The underwriter attempts to simultaneously act as an objective advisor and a commissioned salesman, an inherent conflict of interest. During euphoric bull markets, this conflict frequently results in the distribution of abysmal, low-quality equities at utterly absurd valuations. The intelligent mind will respect the data provided by reputable underwriters, but will subject every offering to ruthless, independent scrutiny, never trusting the ultimate valuation solely to the judgment of the entity profiting from the sale. Finally, while the local commercial banker can provide a steadying, highly conservative influence for the novice seeking the absolute safest harbor, their inherently rigid posture renders them of little use to the enterprising allocator searching for mispriced anomalies. Even less useful is the pervasive, dangerous habit of seeking financial counsel from well-meaning relatives and friends. The assumption that proximity implies financial wisdom is a frequent, devastating error. In the realm of capital allocation, free advice is almost always the most expensive advice one can receive. In closing, the defensive investor must recognize their inability to independently verify complex financial recommendations. They must explicitly mandate that their advisors, whether paid counselors or brokerage analysts, confine their selections entirely to premium debt and the reasonably priced equities of dominant corporations. The enterprising investor, conversely, works in active, demanding collaboration with their advisors, relentlessly questioning the underlying logic and refusing to execute any transaction until they fully comprehend and independently validate the mathematical premise of the operation. In the euphoric, intoxicating days of the late 20th century market boom, a dangerous culture of fierce, unwavering financial independence took root. Empowered by instantaneous electronic trading and a perilous surplus of unwarranted confidence, millions of individuals severed their ties with the traditional establishments of financial guidance. By acting as their own analysts, strategists, and executioners, they believed they were bypassing the costly friction of Wall Street. However, when the inevitable, brutal contraction eventually shattered the market, many of these solitary operators discovered that their absolute independence was merely a prelude to absolute devastation. This is not to suggest that self-reliance is inherently flawed. Those who surrendered their capital entirely to the whims of traditional commission-driven brokers frequently suffered identical, catastrophic fates. Yet, for many participants, the seasoned judgment and objective detachment of a competent financial professional provides an indispensable stabilizing anchor. A trusted advisor offers not only a vital second opinion on the mathematics of wealth accumulation, but also serves as a psychological lightning rod, absorbing the agonizing self-doubt and paralyzing fear that routinely afflict the solitary mind during periods of severe economic distress. Seeking professional stewardship is not an admission of intellectual defeat, but a profound recognition of the emotional vulnerabilities inherent in capital allocation. The intelligent mind must remain acutely aware of the internal and external signals that demand the intervention of a professional architect. If an individual's portfolio suffered wealth-eradicating losses during a market plunge, losses that vastly exceeded the broader market's decline, their underlying strategy is fundamentally, perhaps irreparably, broken. Whether this devastation was born of sheer recklessness, intellectual laziness, or simple misfortune is irrelevant. The magnitude of the destruction screams for expert remediation. Similarly, an inability to master the fundamental mechanics of personal finance, evidenced by a chaotic inability to save, chronic debt accumulation, or a total ignorance of one's own expenditure, dictates the immediate need for a comprehensive, externally imposed financial blueprint. Furthermore, the illusion of diversification often masks a terrifying concentration of risk. Amassing dozens of overlapping, highly correlated assets, such as a myriad of digital equities or redundant growth funds, is akin to assembling a choir composed entirely of sopranos. It completely lacks the harmonizing, protective balance of true diversification. Finally, the sudden onset of complex life transitions, the complexities of self-employment, the burden of aging dependence, or the labyrinthine rules of tax and retirement legislation, requires the steady hand of a seasoned navigator to ensure that wealth is not needlessly forfeited to the revenue service or poor planning. The financial landscape, unfortunately, is heavily populated by charismatic operators who thrive on extracting unearned trust and who actively discourage rigorous independent investigation. The intelligent allocator must approach the selection of an advisor with an impenetrable wall of skepticism, adhering strictly to the doctrine of verifying every single claim. The search for a steward often begins within one's own trusted circle, seeking referrals from respected peers who can vouch for an advisor's integrity and value. However, a warm recommendation is merely the opening sequence of a rigorous due diligence process. The prospective client must become a relentless, unforgiving investigator, combing through the mandatory disclosure documents required by federal and state regulatory agencies. The allocator must actively hunt for any historical trace of disciplinary action, customer litigation, or ethical breaches. A pristine, unblemished regulatory record is the absolute, non-negotiable prerequisite. Any advisor who attempts to conceal or obscure these public filings must be immediately and permanently disqualified from consideration. The vocabulary employed by a prospective advisor serves as a highly sensitive, immediate warning system. The intelligent investor must remain hyper-vigilant for the toxic, manipulative lexicon of the financial promoter. Phrases that promise guaranteed returns, whisper of exclusive offshore opportunities, guarantee market-crushing performance, or manufacture a frantic, artificial sense of urgency are the undeniable, glaring hallmarks of a charlatan. The true financial professional speaks in the sober, measured language of risk mitigation, long-term objective planning, and statistical probabilities. They never resort to the breathless, high-pressure theatrics of a casino barker, recognizing that the management of wealth is a solemn responsibility, not a venue for making impossible promises. The process of interviewing a potential steward must be an exhaustive, probing interrogation designed to unearth the advisor's fundamental philosophy and ethical core. The prospective client must demand absolute clarity on the advisor's underlying motivations, their historical performance and behavior during severe market panics, and their specific, repeatable methodologies for asset selection. Crucially, the investor must relentlessly expose any hidden conflicts of interest, demanding total transparency regarding the advisor's compensation structure. An advisor who secretly derives lucrative commissions from third-party promoters or who espouses the destructive, mathematically flawed practice of market timing must be summarily rejected. The ideal candidate will provide a pristine, easily comprehensible fee structure, a verifiable record of long-term client retention, and a willingness to clearly explain complex financial concepts without resorting to impenetrable jargon. Ultimately, this selection process is a mutual, highly critical evaluation. An elite financial professional will subject the prospective client to equally rigorous scrutiny, seeking to understand their emotional triggers, their historical reactions to market volatility, and the fundamental realism of their financial expectations. The paramount value of a great advisor lies not merely in the mechanical selection of assets, but in the relentless, unwavering management of the client's own psychology. The advisor stands as the ultimate, necessary line of defense between the investor and their own worst, impulsive tendencies. By mutually forging a comprehensive financial blueprint, an unyielding investment policy statement, and a rigid mathematical asset allocation plan, the advisor and the client construct an impregnable psychological fortress. These foundational documents bind the investor to a rational, multi-decade strategy, ensuring that momentary panic or euphoric greed never derails their ultimate financial destiny.